We've had the South Korean market responding very negatively around retail selling of EV-related stocks, it seems. But that's part of the backdrop here. Nasdaq futures we've got here because, of course, we've seen some of those tech earnings coming through, the likes of Microsoft reporting and Alphabet. A pretty mixed picture so far. Not a great deal of decisive conclusions yet to be drawn about the tech earnings story, perhaps. And so Nasdaq futures pretty unmoved by that. And we are focused on the Fed today, of course, with the Fed rate decision later on. But we will have the ECB tomorrow. So worth just checking in with where we are on the euro as we run to that 110.64, so pretty flat. And the Brent crude price, 83.28, a little bit higher than it was, of course, hanging on to some of those gains created by China enthusiasm. Let's just quickly check the futures. The CAC 40 futures down by 0.5%, and this could be the LVMH effect, very heavily weighted over in Paris, of course, and some concern around what they had to say about the US market in particular, despite a bit of a rebound over in China. So let's get to the start of the European trading day. We are seeing the FTSE 100 then down 0.1% or 2%. The Australian dollar is interesting. That is weaker on the back of some sluggish inflation data, which makes people increasingly think perhaps the RBA pauses next in its rate hiking cycle. The Spanish pound down, the British pound down 0.1%. The Spanish IBEX just opening up and is pretty flat. Waiting for the CAC Carol to open up, though, really. That will be the interesting one to see the extent of the effect of that LVMH number. There you go, down by 0.7%. So the French market really in focus because of that luxury story. Let's roll on and have a look at what we've got on the sector picture, and that might stand out in terms of consumer goods. We might see some weakness coming through there, and that would be the LVMH. There you go, consumer stocks down by 1.7%, so LVMH no doubt in the mix there. Retail is flat, industrial's flat, banks pretty flat. So some of the sectors where we've seen some earnings coming through, we're not seeing a great deal of movement overall. The banking sector is certainly one of those. Basic resources down by 1.4%. Travel and leisure continues to be an area of weakness, although it's actually pretty flat just now. Let us get an update on the markets with Sophia Horta-Acosta, who joins us from the Markets Today blog. And I suppose it's an interesting day, isn't it, Sophia, in terms of the market psyche, because we're looking ahead to the Fed, so perhaps some people hesitant to take such big positions as we wait to sort of tick that one off, and then the ECB and then the BOJ. But we've also got a host of corporate earnings stories to digest, which aren't necessarily giving us a clear narrative just yet.
Yes, exactly. And which narrative do you pick, Anna? I mean, the story around the Fed is very much that a rate hike today is all but priced in, and people really looking ahead to how you trade the market beyond that. Some investors are already kind of looking at a world beyond that, looking at what Powell will say about the inflationary picture going forward. But also the BOE might be the big risk in August, and let's not forget also the ECB. We have the ECB update tomorrow and the BOJ on Friday, so a lot to factor in on the macro view. But also, we can also get a macro picture from earnings. And Anna, you and I have been talking about what CEOs are saying about their inflationary outlook and where their pricing power is and where they see the consumer story going forward. So again, a lot to digest for today, but markets kind of treading more cautiously than they were yesterday.
Yeah, and it's really interesting, isn't it? On the one hand, we're talking about the corporate earnings story, which is by definition a little backward looking, talking about pricing power and inflationary forces still in evidence. And then at the same time, we have a story across the Bloomberg that says Wall Street is already positioning for a post-rate hike world, as if we think inflation is, is beaten and, that banks are going to be able to start cutting interest rates. Take us through some of the conclusions here.
Yeah, and you have some people warning, let's not really get ahead of ourselves here, because that disinflationary optimism really came through after the US CPI print, then was reinforced by the UK CPI print as well. And the market is really looking for evidence to, to really kind of grab onto that narrative that we're past inflation, we've beaten inflation. Inflation is still high. There's still a lot that central banks need to do. Powell is likely to stay on message today and say, that there's still upside risks to inflation, and we're not really going to go into the pausing cycle quite yet. But what the market is doing is almost looking ahead to the economic growth picture. Are we going to get a hard landing or not? Is recession on the cards? And
yes.
and will central banks actually need to cut interest rates? Maybe that might be taking it too far.
Maybe, yeah. And that whole soft landing story got a bit of a boost yesterday, didn't it, from the consumer confidence data, which did look to be, well, it was the strongest in 2 years, I think, wasn't it? Which doesn't feel all that recessionary. Let me ask you about what's going on the UK markets then, the FTSE 100. Goldman strategist saying that the FTSE 100 calls are attractive in a value rally. What's the thinking there?
Yeah, so we had Morgan Stanley a few weeks ago saying that UK assets are the cheapest in the world, and that provides an opportunity. Then we had BlackRock raising their outlook from underweight to neutral, which essentially says we're not so negative on this market anymore. And now Goldman is saying, actually buying calls, and these are kind of bullish derivatives that give you upside. Give you some exposure to an upside scenario. So they're saying, hey, a lot of people are actually underweight this market given the inflationary outlook here and given how negative people are in the economy. But there's a risk that the market will go up. So make sure that you're hedged for that, preparing for that. There seems to be a positive hum around the FTSE 100 right now. Let's see if this kind of takes hold. We did see a 6-day gain in the FTSE, which looks to be breaking today. It's very vulnerable to the China growth story. But it's starting to become a theme, Anna.
Yeah, thinking about that China growth story, I was discussing with Mark how he mentioned that he thinks you can sort of find anything you like in some of the European corporates and what they're saying about China. You can find things that support your pro-China or anti-China view in terms of where stocks go and the economy goes from here. We've obviously had that LVMH news that's shaken markets a little bit, but that's really around disappointment in the US and the China story looking more positive. Are you seeing anything interesting in the earnings picture from European companies around China just yet?
I think looking at Europe is actually really important when it comes to the China growth story, because that's where actually people were trading that early in the year. People were actually buying European equities to play China's economic recovery from the pandemic. When it comes to China growth, and you look at LVMH, you look at other luxury stocks reporting double digits, sometimes in the 20s, 30s, that looks really good. But last year, China was in lockdown. So the year-on-year picture, it's a very easy kind of low base that we're dealing with. So I think the theme here is that the US is slowing. There's slowing demand there, and that was kind of well flagged, but also maybe perhaps worse than the market was expecting. And China growth is not enough to kind of offset that.
Okay.
So that's kind of really where the market is treading water between the two.
Okay, that's interesting. Thanks so much, Sophia. Sophia Horta-Acosta from our Markets Today blog. You can find the stories that the Markets Today blog are covering. Go to the Bloomberg UK website, click through onto the blog, or you can type TLive Go, TLIV Go into the Bloomberg terminal. Let's check in on some of the individual stocks that are on the move this morning. Joe Easton has a briefing. Joe?
Where the key banks are opening up in early trading. Anna, so Lloyd's down around 2%. This mostly looks due to deposit migration, so clients chasing those higher interest rates. Lloyd's having to pass that on. Potentially a bit of a read across coming from NatWest as well, which was down around 3% following the shock news of the CEO's exit. Santander, meanwhile, unchanged. They have got strength in the main Eurozone and Spanish business, but Brazil looking really weak. That's a big part of the business, the economy declining there, weighing on loans in the Latin American country. Meanwhile, UniCredit, one of the best performing banks today, they've got a smaller than expected loan loss provision, so loan defaults not as bad as expected at the Italian lender. Deutsche Bank, meanwhile, they are declining almost 2%, got a share buyback and better than expected trading revenue. However, the costs are a lot higher than expected. That's partly due to wages and also due to some litigation concerns at the German lender. Just going to flip over to a few other selected movers that we had on the screen. One I was looking out for is Uniper over in Germany, up 23%. The best performer that we've got among the large caps. This is the German renewable energy and broader energy company, raised their guidance after the closing of trade yesterday, and that stock rocketing on the DAX. Meanwhile, Reckitt, the big cleaning product company here in the UK. That one actually looked pretty strong to me. Their sales of Dettol and other products seem to be holding up. That stock's declining, probably a bit of that priced in. Glaxo, not too much action there. A mixed one. HIV pretty strong, as were allergy medicines, but we're waiting to see some more of their products come onto the production line in terms of some of their trials that they've got coming up. The big one though, LVMH over in France, as you mentioned earlier, that one's sliding, weighing on all the luxury stocks. The slowdown in the US is the big concern, particularly in the drinks market. The leather goods, probably not too bad, but it is really the drinks market where we're seeing a decline on the quarter. In terms of a few other stocks, I think we're going to bring up here. I'm hoping, there we go. So Rolls-Royce, 16% gain for Rolls-Royce. They're saying that the travel business is rebounding. They make engines going into planes like Boeing, and that whole sector was down yesterday following a negative report from Raytheon over in the US, which sent all of the European peers lower. Meanwhile, Varta, now this is a company which makes batteries which go in AirPods. The amount of times I've lost my AirPods, I've bought about 5 pairs, I think, but that stock down 6%. The whole tech space not doing very well today. Their guidance was slightly weaker than expected in terms of their top line. ASM, also in tech, semiconductor machinery, not too much action there, pretty much unchanged. We've got an eye on SAP following Microsoft's earnings, but that one pretty steady at the moment.
Okay, thanks so much, Joe. Joe Easton from our equities team, being careful where he puts his headphones from now on, no doubt. Really interesting to see the way that the market is responding to upgrades. Where we see them, it seems the market jumping on those. Let's get a look at what is ahead for us today in terms of the trading diary. At 3 p.m, we get US new home sales data. Then at 7 p.m, we'll be getting the closely watched, of course, FOMC rate decision, where officials are widely expected to resume rate increases after they paused their 15-month tightening campaign in the month of June. What kind of guidance will we get, if any? We don't get new dots, we don't get new estimates, but what kind of guidance might we get from the Fed around this, from Powell, around this rate decision? Throughout the day, the Salzburg Summit will be taking place as well. That's in Austria. Speakers include the Deutsche Bank CEO, Christian Sewing, and the EU Commissioner, Paolo Gentiloni. And also later in the day, Meta, Boeing, and Coca-Cola report earnings. So we continue to focus on tech stateside after hours, but also on some of those other big consumer and industrial names. Coming up on the program, it's not all about earnings today. We'll also have the Fed's rate decision, as mentioned in the daybook. We'll discuss that with Grace Peters from JP Morgan Private Bank. That's next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
ECB is expected to hike rates. But how high will rates need to go? And how fast will they get there?
The ECB is still catching up.
They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Most questions will persist up until Lagarde goes on that podium.
Coverage begins Thursday on Bloomberg, your global business authority.
The biggest threat remains inflation. We've had some good news on output growth. We've revised upwards a little bit. I mean, there was quite a bit of resilience in the global economy, but especially in the first quarter. But, you know, the momentum is slowing down, and this is why, at the end of the day, the revision is not stronger than what it is, and why we're going into next year also with relatively modest growth.
That was the IMF's chief economist on the fund's revised forecast for global economic growth and the path of inflation. Now to the Fed, where policymakers are poised to hike interest rates to their highest level in 22 years. JP Morgan Private Bank thinks the 25 basis point hike will be the central bank's final one of the cycle, with global rates likely to fall in 2024. Let's talk to Grace Peters from JP Morgan Private Bank's EMEA Head of Investment Strategy is her role there. Grace, very nice to have you with us. Thanks for joining us. I just want to sort of jump off what we were hearing there about the IMF's view of the world. They're talking about resilient growth and inflation still being such an issue, and yet Wall Street seems increasingly convinced it wants to position around a rate-cutting world. Is there something a little disconnected there? Where do you fall down on that?
I think with resilient growth comes resilient inflation, no doubt. So we mustn't get complacent and think that the fight against inflation is totally won. We do think this will be the last rate hike, that the Fed needs to put through a couple more from the ECB, and that then they'll be on hold. And obviously a hold is very different from a cut. To see a cut, you need to see some degree of economic weakness coming through. The interesting thing, I think, about market pricing is that the market price is about 150 basis points of cuts through the balance of 2024. That still leaves us with a pretty tight monetary policy backdrop. That's still above, you know, sort of most estimates of the neutral rate, which tells me that the market is saying inflation remains sticky, particularly core inflation. Rates can come down from these very restrictive levels, but we're still going to be far more restrictive than we've been in recent years.
Okay, so that's trajectory of rates that you expect to see, and as it develops with rate cuts through 2024. How are you thinking about how long the Fed pauses for and the value of that? I wonder, because we hiked so quickly, whether that takes us to a place where we don't pause for that long because the chances that something breaks are perhaps elevated, and then we have to get into cutting more quickly. How are you thinking about the length of that pause?
So I think it is important to be data dependent. The Fed's going to watch the data points even before the September meeting. We've got a couple of CPI prints, we've got jobs data. So I think we have to say that every meeting is live to some extent, to the extent that the data, you know, sort of comes through to support our view that we are in a period of disinflation and that you're going to continue to see inflation coming lower. Now, as for when the first cut comes through, we have that penciled in for next year in the first quarter, because at that point, we think growth will be starting to weaken. And when I mean growth, I also am alluding to the labor market. Wage inflation, if we see wage inflation in the US, which is currently still in the mid 4% level, if we see that down at 3.5%, that's more consistent with the Fed being able to achieve its mandate, and therefore it can take its foot off the gas a little bit. And as you mentioned, Anna, there are financial stability risks out there. The markets look through that now. It's sort of, you know, got over the banking stress that we had in March, but we mustn't get complacent about that either.
Are you going to see a contrast, do you think, in the growth stories in the US and in Europe? You mentioned there about when we get to rate cutting and the softness that we might see in the labour market that might trigger that. But at the moment, there seems to be a lot of time dedicated to talking about a soft landing in the US. And yet, the start of this week, we began with PMI data out of Europe that looked really quite poor and seemed to disappoint on all fronts, as if we are maybe in recession in parts of Europe. How do you expect that sort of divergence to play out?
Yes, I mean, through the second quarter, there was a very clear divergence between the US data, PMIs, confidence surveys, all improving, and Europe definitely disappointing on a steeper declining trajectory, I think, than we had envisaged. European rates, I think, are not as restrictive as the US. You do have, I think, more of an underlying inflation issue in Europe when we think about the construct of the labour market. Some of the more recent wage prints that we've seen coming through are still actually on a rising trajectory. So I think think that the ECB has got, another couple of hikes to come in. I think that they will be hiking for longer than the Fed, and they will be on pause, at those higher levels through much of the first half of 2024, I think.
Okay, and if I could just go to the earnings stories, because some of these have been really fascinating. I'm really taken by the way that if you're guiding higher in an earnings season that perhaps had slightly low expectations or people weren't expected to be blown away, if you guide higher, the market can actually jump on that. And we're seeing that in the case of Rolls-Royce, for example, surging to a 2020 high after hiking its profit outlook. The more miles its engines fly, the more maintenance money it gets, which is always part of the equation there. But more broadly, what are you taking away from the earnings story right now?
So we're expecting a good earnings season. We've had a good earnings season in the first quarter. That was one of the reasons that markets have moved higher through the course of this year. And I think it is, we spent a lot of time already this morning talking about the macro, but the micro is really what we think drives the stock market over a period of time. And we've been equity bulls, and we remain the case. So we've got a price target for the S&P of 4,500. We think Europe can actually do a little bit better over the next 12 months. And so we don't want to get too bogged down in, obviously we know rates are important, but the earnings picture is incredibly important, and we think that that will continue to be resilient. The bar is slightly different depending on the part of the market you're talking about. We know in Europe, luxury has been a huge theme. In the US, AI and tech has been a huge theme. So for those parts of the market, the bar's a bit higher. But for the rest of the market, actually, I think earnings beats can come through, can drive markets broadly higher over the next 12 months. And we do believe in the broadening out theme, particularly in the US. We think that to get to, if you wanted to factor in a soft landing, we think the S&P could be closer to 4,800 over 12 months.
Right.
And that requires a broadening out of
What delivers positive news, though, for Europe? Because if you look at the luxury sector, which has been such a positive driver at the beginning of this year, a lot of expectation around what happened in China. And now we see disappointment from LVMH, not necessarily around China, but around their US business. And just that name alone taking 37 points off the CAC 40 in this morning's session, such as the heavy weighting of some of these really huge luxury names. So if it's not going to be luxury that provides any positive surprise, where are we going to see that coming through in Europe?
I think so. So the expectation for European earnings growth this quarter is minus 10%. That compares to minus 7% for the US. A large amount of that negative delta, both absolute and relative, comes from energy. So, when you actually strip out energy, European earnings are expected to be flat. Luxury has been a big driver of the story. The consumer at large has been, and China as well. So we do need all of these bits to stay resilient for Europe to continue to perform. But let's not forget, Europe is a global market. So when we're thinking about the stock 600, only some 45% is exposed to the European region. It is other regions that drive earnings growth broadly. And I think particularly for both sentiment and underlying earnings, China is important.
Okay.
It is about 20%. And we've seen, even from LVMH and Richemont, another luxury name that reported last week, the China growth story in these parts is still pretty robust.
Really interesting that Europe is more non-Europe than it is Europe. Grace, thank you very much. Thanks for joining us. Grace Peters, JP Morgan Private Bank's EMEA Head of Investment Strategy. Coming up, no champagne, no game. We'll stick with the luxury story. LVMH US sales declined, hurt by a sluggish economy and weaker demand in its wine and spirits unit. We discuss earnings from the luxury giant next. This is Big Day.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus. And Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back. Let's talk luxury. LVMH shares are slumping today after the luxury giant's US sales declined in the second quarter. That's as a sluggish economy deterred some shoppers from buying its high-end clothes and handbags and perhaps some drinks as well. For more, let's bring in Bloomberg Opinion's luxury and retail columnist Andrea Felsted, who's with me on set here. Andrea, good morning. So is this the end of the luxury boom? It's been such a driver since the start of the year.
It certainly looks like we are moving to perhaps a more normal phase of growth rather than the hyper growth we've had for the past 3 years as we emerged from the pandemic and everybody bought goods and luxury items when they perhaps couldn't do other things such as travel.
Okay, and so how is LVMH placed in this new kind of environment? I think that some of the weakness coming through in the US and specifically around the drink sector?
That's right. It's all to do with this US aspirational consumer. That's affecting demand for fashion and leather goods. It's also affecting demand for cognac. Despite that, LVMH is pretty well placed. It's the biggest luxury group. It's got two of the most powerful brands, Louis Vuitton and Dior. And it's got the resources to shout louder than everyone else to get its brands at the forefront of consumers' minds. So even if we do move to a slower phase, it should be pretty resilient.
Okay, so we watch this aspirational consumer, and how does that play into conversations around other luxury names? Because they're all exposed to different parts of that. Some more to the aspirational consumer, some to the very rich consumer already. We're going to hear from Kering and from Hermes later this week.
They will be absolute case studies because Kering with Gucci more exposed to that premium shopper. Hermes with the Birkin and Kelly bags, more exposed to that super luxury shopper.
So, and that's higher than premium?
That's higher than premium,
okay,
yes. So those bags are sort of approaching sort of $10,000. So if you can get your hands on one, that is, quite an upmarket consumer. So they should be more resilient. I think there'll be a real contrast between those two later in the week.
Okay, yeah, so that contrast between the aspirational and the sort of super rich, interesting to watch. Andrea, thank you very much. Bloomberg Opinion's luxury and retail columnist Andrea Felsted with the latest on LVMH and what it means and doesn't mean for the rest of the luxury sector. Coming up, NatWest CEO Alison Rose is stepping down after a row over the way the bank closed accounts held by politician-turned-pundit Nigel Farage. We will get into the details. Late last night, it seemed political pressure was being applied to the CEO. There was a scramble to call a late-night meeting of the board at NatWest, and we now know the outcome. NatWest CEO quits over the Farage controversy. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European earnings in focus. LVMH shares slide on weak US sales, while Lloyds misses as higher bad loan charges drag on second quarter results. We'll be speaking to the UK bank's CEO shortly. Meanwhile, Alphabet posts a revenue beat, while Microsoft shares fall on tepid cloud sales. European shares are down as investors reduce risk ahead of the Fed rate decision. Plus, NatWest shares drop as the CEO, Alison Rose, resigns following a row over the way the bank closed accounts held by the politician-turned-pundit Nigel Farage. Welcome to the programme, everybody. Let's have a look at where we are across European equity markets right now. So half an hour into the trading day, and we have weakness coming through. In particular, actually doesn't feature here, but the CAC 40 down substantially, and more than 30 points being taken off the CAC 40 as a result of LVMH's decline today. But elsewhere, modest losses, really. Flat on the FTSE, the DAX down by 0.2%. We've had earnings stories coming out all over. The focus of the negativity, though, in terms of the size of the move over at LVMH. Let us have a look at where we are on the sector picture, and no doubt that will bring out some of that LVMH story. We'd seen weakness around half an hour ago. We certainly saw weakness in the consumer area. There we go. Consumer stocks down by 1.9%. The LVMH effect there that we discussed with our colleague Andrea Felsted a while ago. Basic Resources also weaker, but that's not taking too much out of London. We're flat on the London market, as you see. There's the CAC 40 down by just over 1% as a result of the weakness in that LVMH story. I can see a fairly mixed picture, though, when it comes to the sectors overall. We've had a host of earnings reports coming through from the banking sector. Deutsche Bank shares are lower this morning in Frankfurt as investors focus on mounting costs of severance payments and litigation. That is, to some degree, overshadowing a better than expected trading environment. We spoke to the CFO, James van Moltke, about the outlook for the European economy.
It's sort of a mixed picture, as I said earlier, but in part what I mean there is Germany and Europe more broadly has been somewhat stagnant in terms of its growth these past several quarters. Sort of at around zero. We do expect that to be a little better in the second quarter, but what you're seeing is the effect of certain sectors, so building, for example, and real estate being in a recessionary territory. Other sectors like services, growing quite strongly. So there's a mix going on. And to your question, what is the dynamic going forward of recovery in those areas that are recessionary? What's going to happen with sort of the industrial order books and the export market? All of those things are in play. but I think the conditions are in place to see sort of steady growth starting, either late this year or into 24.
And just very quickly, because we have not much time left, when we just think about the balance of risks for clients, what are they most worried about now? Originally, is inflation, then recession, then kind of geopolitics. What do you think is the kind of guide right now is preoccupying?
Look, I think geopolitics is front and center. I think, as I say, I think the direction of rates probably more clear. People are getting more comfortable with the direction of the economy, and that really leaves sort of geopolitics as the big unknown that we're dealing with. So as more of these clouds begin to clear, as I say, the conditions are there for a growing economy and a normalized rate environment, which should be good for the banks.
That was the Deutsche Bank CFO, James van Moltke, speaking to Bloomberg's Oliver Crook after the bank's earnings report earlier on today. Let's have a quick look at where we are on the banking stories. And this is the picture for you. We have Deutsche Bank down by 1.5%. We were just hearing the story at Deutsche Bank there from my colleague Oliver Crook and James van Moltke. The Santander share price up by 0.8%. We spoke to the CFO of that business a little bit earlier on. UniCredit, the stock has outperformed many in the sector over recent months, and it's up by 1.5% today. So continues that trajectory. And on the UK banking sector, Lloyds is in focus because of its earnings report. On the one hand, increasing return on tangible equity and net interest margin guidance, but on the other hand, the second quarter numbers missing because of increased provisions or lower expectations about how many of those debts get paid back to the bank. So the stock down by 4.2%. Let us stick with the European banking theme. NatWest shares falling this morning after the CEO, Alison Rose, stepped down following a row over the way the British lender closed Nigel Farage's bank account. Rose resigned after she admitted leaking information about the politician turned pundit to the BBC. The leak related to Farage's status as a customer of Coutts Bank, which caters to some of the UK's wealthiest people, including members of the royal family. Well, this story has everything, doesn't it? Let's bring in Will Shaw from our finance team, who can bring us some analysis of this. And I know, Will, that you're deep into this story. You've spoken to Nigel Farage a couple of times over recent weeks, and he's been speaking a lot about this story, obviously. Given the political pressure on Alison Rose, we had a story last night that suggested even the Prime Minister was piling in with some political pressure on her. Was it inevitable that Rose had to go?
I think the short answer is yes, it was inevitable, but it didn't look inevitable until it was actually happening. So at around 5 p.m., shortly after 5 p.m. yesterday, the bank put out a statement in which Alison Rose admitted, yes, she'd spoken to the BBC about Nigel Farage's bank account and why his bank account had been closed. She apologised for that. She said she shouldn't have done it. In the same statement, Howard Davis, who's the chairman, said Alison Rose has made an error of judgment, but we still have confidence in her. Then everything went quiet for a while, and around 1:30 in the morning London time, there was suddenly a statement issued saying actually Alison Rose is leaving by mutual consent. As to why this is inevitable, I think, as everybody knows, NatWest is still heavily owned by the British taxpayer through the UK government. The government has about 39% voting rights in NatWest. Now, it's a Conservative government. There's plenty of people in there who have similar views to Nigel Farage. There's a certain amount of sympathy in there. People close to the Prime Minister and to the Chancellor last night were briefing that they weren't happy with Alison Rose staying on and that she should consider her position. So yes, I think inevitably it was written in the stars.
Okay, so it's a fast-moving story. It has been fast-moving. We will see whether this resolves things for the bank, whether they have more to do on this front. Clearly, they've said they're going to do a review. We'll see where this takes us in terms of NatWest leadership and who is put in place there. But I want to go to the broader conversation, because this raises really the individual case around Nigel Farage has taken us to some really interesting places in terms of how politically exposed people are treated by the banking sector, but also how others are debanked by the banking sector and how there isn't a great deal of visibility as to why. What kind of changes, Will, are we likely to see here?
So I think this point about politically exposed people is probably a bit of a red herring. I mean, there's been a lot of talk in the media about how that played into why Nigel Farage's bank account got closed. In fact, from the internal documents released by Coutts, or released to Nigel Farage by Coutts, we can see that the concern was not that he was politically exposed, but that he didn't share their values and he didn't share their outlook and commitment to diversity. Now, I spoke to Nigel Farage this morning. morning. He said he's only just getting started on this issue. Lots of people on both sides of the Brexit debate have been in touch with him, he claims, to say how much they supported him in this. He said lots of people are having their bank accounts closed without good reason, and this needs to stop. He will be pushing for that. The UK government has also indicated, obviously, that it wants to make it harder for people to have their bank accounts closed after they've used their freedom of expression within the parameters of the law.
Okay, so, I mean, and Nigel Farage has said that he's still looking for a bank account, isn't he? So certainly for his business, so we'll see where that takes him. And he's also talked about this as an opportunity for fintech firms. So it could be something that has wider impact on the sector. Will, thank you very much. Will Shaw, from our finance team, with that fast-moving story around NatWest, Nigel Farage, and the bigger principles involved here. Let's go to the technology sector, where we've also had earnings coming out. Big tech led gains in equities during yesterday's session, with traders counting on the earnings season to see whether the enthusiasm around artificial intelligence will justify this year's market advance. Here with details, our tech reporter, Aggie Cantrell, who can take us through what we've learned. Aggie, what stood out then from the Alphabet earnings? Let's start there.
Yes, so the thing that I thought was really interesting from the Alphabet earnings is that there's been a lot of noise in the market and also in Silicon Valley about whether OpenAI, ChatGPT, and Microsoft's investments in OpenAI could present Bing as a real competitor to Google search engine, essentially the most dominant part of Google's ad revenue space is their digital advertising they get from the Google search ads. And they have basically shown this quarter that really Google remains completely dominant in that space. They are investing themselves in AI in their Bard product, but when it comes to competitors like Bing, they don't really see that as a competition at the moment. It was also interesting for me to see that the Google Clouds continued to show a strong growth and was profitable this quarter. This means that last quarter, when they turned a profit for the first time ever, that wasn't a fluke. They've managed to sustain that profitability in their Google Cloud sector, even though they're still behind Amazon and Microsoft in the cloud space. And also, when you look at YouTube advertising, that was considered to be potentially a sore spot for the company. That seems like it has also recovered somewhat.
Okay, a lot of focus on tech earnings. Aggie, thank you. We got Microsoft sales growth, which looked pretty tepid in the quarter as well, didn't we? And numbers through from Snap. Thanks to Aggie Cantrell for the update there on the tech earnings season. Now, coming up, we'll get back to the banking stories. Lloyds Banking Group shares are sliding this morning after the UK lender reported a pre-tax profit miss. We will speak to the CEO, Charlie Nunn. That's next. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Markets Today, 43 minutes into our European trading session, and a little sluggish across European equity markets. In particular, the Dow draft over on the French market, down 0.9%. On the CAC 40, the luxury sector not doing very well there. Let us talk to the Lloyds Banking Group now. Lloyds Banking Group shares have fallen in early trading in London after reporting second quarter earnings. The lender took higher bad loan charges, which dragged its earnings below expectations in the last quarter. However, it did lift guidance for the rest of the year. Let's talk about that with Charlie Nunn, the CEO of Lloyds Banking Group. Charlie, thank you so much for coming to speak to us. So let me ask you about this guidance and the contrast that we see in the guidance message versus what you're sort of reporting backward looking. On the guidance, you've increased guidance around return on tangible equity, around net interest margins, but on the second quarter, it seems that you've missed estimates because of higher impairment charges. What kind of message are you looking to pass on to the market this morning?
Morning, Anna. It's great to be here. So, I mean, first of all, we had robust financial performance in the first quarter. It's obviously a challenging external environment for our customers in this context, and we've had a lot of focus on supporting customers. But what we've announced today are robust financial performance for Q2. And as you say, we had guided to the year 2023 evolving in a very specific way. And we've actually raised our guidance for the second part of the year. I think the third message, which is really important, is the confidence we have around the strategy we're executing and our recommitment to our targets for really growing the organization and supporting our customers in 2024 and 2026.
Okay, so that's your commitment there. On the second quarter numbers, though, that higher impairment charge, what's the trajectory that you now brace for, though, in terms of impairments at Lloyds Banking Group?
Yeah, actually, in terms of our impairments and our credit performance, it's been really resilient. We guided at the start of the year, and in Q1, our impairment numbers were about 30 basis points in terms of our guidance for the year. When you look at the underlying impairments for quarter two, it was 29 basis points, so very much in line with our guidance. And that's what we continue to see, real resilience around our credit portfolios. The additional add-on in Q2 was specific to some economic scenarios. We updated our outlook for the economy, and although it's a bit stronger in 2023, we actually are saying that there's not going to be a recession in 2023 now. There's going to be modest growth. We are also predicting, because rates will be higher for longer, that unemployment will get a bit higher into 2025. And so the economic adjustments we made to our impairments reflect that forward-looking view. Underlying impairments show real resilience, and we're guiding to the same guidance we've given for the last 6 months.
Okay, but it's that the effect of higher unemployment rates that you're sort of factoring into your macro assumptions there that has that effect. Let me think about other vulnerabilities in the UK economy, and of course this takes me to the mortgage market, Charlie. You are Britain's biggest mortgage lender over at Lloyds. How vulnerable do you think that the market is in terms of mortgages around remortgaging? This is going to be a strain on many households this year.
Yeah, so it's been a really challenging 6 months, 9 months for our customers in a very dynamic market. Actually, what we're seeing again is enormous resilience of our customers. Just to give you a few stats, in the last 6 months, customers who have come off a 2 or 5 year mortgage deal have increased their monthly payments by about £180 per month. As we look to the second half of the year, that's going to be more like £350. So a really significant increase for our customers. Now, the good news in that context is the majority of our mortgage customers, first of all, are on fixed price deals. So actually, only about 35% of our mortgage customers will see an increase in their interest rates this year. That means people that locked in a 1-2% deal in the last few years are going to continue to be protected from interest rates going forward. And then for those customers facing... Sorry, Anna.
So carry on. Sorry, carry on, Charlie.
No, and then for those customers facing into those higher mortgage payments, the average salary or household income for a mortgage customer is £75,000. So it's challenging. They need to adjust what their spending patterns are. But the vast majority of our mortgage customers we're seeing are adjusting well, and we've not seen an increase in arrears overall in that context.
Okay, and what are customers turning to if they come off those fixed deals, Charlie, to try and cushion themselves? Are they looking to new 5-year deals? We heard this recently from NatWest because they're looking for certainty, or more recently perhaps looking at trackers because they're assuming maybe we get to the end of the hiking cycle. What are people doing?
Yeah, so actually in Q4 last year after the mini budget, there was a real growth in trackers, people looking at a tracker, and that lasted for 3 or 4 months. Actually, again, as we've come into this year, we're seeing our customers look for more certainty again. And it's balanced between 5-year and 2-year deals, but they really value that certainty. And that's what we're seeing customers look at.
Okay, and what impact is all of this in the mortgage market having on mortgage margins, given what you've said there about the salaries of the people that you provide mortgages to? Maybe not too much, but what's the margin outlook for the mortgage business?
So again, our guidance around mortgage margins has been consistent. Mortgage margins are tight. They're about 50 basis points. And if you compare that to some of the mortgages that are rolling off, those that were 2 years ago, for example, 3 years ago now in 2021, mortgage margins at that stage were more like 150 to 200 basis points. Now that's great because that means although with interest rates going up, mortgages now are much higher cost for our customers. They're 1 to 2% lower than they would be. So that's good in that context. And that's why we guided towards our net interest income and net interest margin declining in Q2, which is what we've seen. Actually, it's declined a bit less than we guided to, but we saw that our mortgage customers would be getting tighter rates and that we would be passing on more to our savers, and that's what's happened.
Okay, can I turn to another subject that, of course, has got a lot of attention recently? Nigel Farage publicising, of course, the fact that he has been debanked, as the verb goes, and he's trying to find banking facilities. And it's sparked a wider conversation about this topic. I wonder if you're revisiting your debanking policies at Lloyds Banking Group, the criteria that you apply if you decide to withdraw someone's bank account, Charlie. Are you revisiting those policies?
No, we're not revisiting them. We had a really clear policy that meant we didn't look at people's political preferences or their personal beliefs as part of the decision as to whether we either opened an account or closed an account for a customer. So we're confident that that's the right policy. Obviously, we did receive a letter from the Economic Secretary this week, and we've got a meeting later today where we're going to talk through are there any enhancements we should be putting in place around when we close accounts for customers. And as we get the details of that, we'll absolutely be looking at it in that context. But our policy, I believe at the moment, is the right one for what we think we're doing for our customers.
And Charlie, do you think then that we will see a change of any regulation as a result of this? And of course, this might be different when we're talking about ordinary consumers and ordinary customers, and we're talking about politically exposed persons. But in either of those categories, do you expect to see changes in regulation?
I think I do. Even just the early discussions with the Economic Secretary, there's a point around disclosure and giving people 90 days rather than 60 days notice around account closures. But let's wait and see what comes out. I expect some changes, but obviously the core of what we do, which is how do we assess a customer and what our policy is, I think the core of that will stay the same.
I wonder if you feel, I mean, you're going to the Treasury today. A lot has been made of the fact that NatWest, of course, has a government shareholder, so you're not in the same place over at Lloyds Banking Group. But the whole sector must feel under quite a lot of political pressure at the moment. And I suppose it's understandable, perhaps, given the role that banking plays. And if people are not able to access the digital payments economy, then that's a big deal these days. How do you think we move forward in this? Because banks want to maintain some freedom to say yes or no to customers, but at the same time, they're providing an increasingly necessary service.
Oh, Anna, you know, I've always believed that the role financial services plays is really important for our society, for our economic development, and then for how we support the politics and social fabric of an economy. Our purpose statement is helping Britain prosper, and that's what we've always been focused on. So for me, this just highlights the importance of financial services, and I welcome the conversations with the government. You know, a good example was the mortgage charter that we launched a few weeks ago after conversations with the Chancellor and our regulators. It was a great example of us coming together to try and make sure, see if we could do anything in addition to support customers at the moment in need. And I'd expect that to continue to be the way we operate in the UK.
Thinking of people, far away from the Nigel Farage example, but at another end of the income spectrum, if you like, areas of society that maybe have felt debanked for a long time and not able to access banking facilities. Is it okay for people to not be able to access banking facilities in this century?
Well, so at Lloyds Banking Group, we have 26 million customers. We have a relationship with half the households in the UK. And actually, for those that I think you're talking about, we have a basic bank account service, and we are by far the biggest provider of basic bank account services to the UK. So we believe that service should be available, and we certainly make it available to our customers. And we make it available through all channels. So that's absolutely our belief.
Okay, really interesting. So thank you for going into the sort of that conversation with me. But stepping back a little to the broader story around the UK economy, we focused on the mortgage market, the vulnerabilities there. You've talked about your changing macro assumptions and what that does to the impairments that you're factoring in. But overall, you're telling a more positive story than maybe 6 months ago around the UK economy, Charlie. How would you assess the UK economy right now?
So it's fragile, I think, is the answer, and it's creating uncertainty for our customers. What we've adjusted in our economic forecast is more positive for 2023, but it actually creates a more challenging environment for the UK over the next 2 or 3 years. We're not predicting a recession, we're predicting slower growth, and that's because we think the pressure on interest rates and inflation is now stickier than we assessed it in Q1 and at the end of the year last year. So it's a fragile economy. It's one that we can see has some growth but limited growth. The good news is that we still think unemployment will remain low, even though we are predicting it will increase. And we think house prices, although we're seeing a 5% fall this year, will remain relatively stable. But we absolutely need to get investment back into the economy and to support customer and business sentiment so we can start investing in jobs and growth and productivity again.
Yes, and I know we've talked about your strategy and you've said you're confident in it, but I wonder how your strategy sits with that as an economic backdrop. It involves digital, it involves corporate banking, but it also involves growing the wealth offering. Is that something that is well-timed right now, or are you having concerns about that, Charlie?
No, it is well-timed. It was very, very, very focused on what we called mass affluent, but it's not the high-end private banking services. This is everyday people with everyday money to invest. And what we're seeing, whether it's in their pension assets, simple investments or savings, is this is a moment in time when people need to build their financial resilience. And actually, Anna, what we've seen at Lloyds Banking Group is we had about £70 billion of additional savings that came into Lloyds Banking Group through COVID. We still have about £60 billion of that. So for those customers that are looking to build their future financial resilience, this is a really important moment in time for them to be thinking about how do they invest that money and protect themselves and their families for the future. So it couldn't be a better time for us to be engaging customers on those issues.
Okay, thank you so much for joining us, Charlie. Really nice to have you on the programme today. Charlie Nunn, the CEO of Lloyds Banking Group. Really great to get your reflections on the UK economy, the mortgage market, the debanking story, which is much talked about, as you can imagine, with that NatWest news here in the UK. Let's move on to some of the stocks that are in focus for us, and we'll check in on the Lloyds share price, in fact. This is Lloyds Banking Group. Then we were just talking to the CEO, down by 4.8% as a result of, the fact that they have missed on their second quarter numbers, perhaps, is one of the drivers of that weakness. LVMH down by 3.7%, so weakness in the United States, weakness in the drinks market, strength actually in China, but that's the LVMH story, and that is so heavily weighted in Paris, it takes a big chunk out of the CAC 40. The Porsche share price is down by 2%. The stock dropping as sales have missed estimates. There's concern around pricing, even for Porsche. That's interesting in the context of the conversation we were having with Andrea Felsted about the super rich maybe being more resilient in her view versus the aspirational rich that were weighing on drink sales over at LVMH. And Rolls-Royce in focus up by 21.5%. This is the engine maker. Of course, they sell engines, but they also maintain engines. And the more miles those engines fly, the more money they make in maintenance. And that's always been a big focus for the earnings stories. And we've certainly seen a big rebound in the travel and leisure sector over the last year or so. And that is playing all to the good for Rolls-Royce. That is it for markets today. We have insights, of course, from the team that puts together this program on the Bloomberg UK website. You can click through into the Markets Today blog. That's where you'll find it. Also, you could go to T Live on the Bloomberg terminal. You'll find the Markets Today blog there. The Pulse is up next. They'll continue to take you through all the earnings stories and move us on towards the Fed. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
The ECB is still catching up.
They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Most questions will persist up until Lagarde goes on that podium.
Coverage begins Thursday on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manus Krenny in Dubai, and here's what's coming up on the program today. The Fed is poised to hike interest rates to the highest level in 22 years, an 11th increase since early last year. U.S. futures and European stocks are mixed. Banks bonanza, UniCredit rises as profits surge. Deutsche and Santander beat estimates while Lloyd's misses. Plus, the NatWest CEO, Alison Rose, resigns following a row over the way the bank closed accounts held by the politician turned pundit, Nigel Farage. There's a skittishness to these markets, there's a fragility to the European outlook, and the heart of Europe is down. France is blood red, but what you have a story here is, of course, demand for credit is reducing. Louis Vuitton, the aspirational wealthy, are not spending as much. Is today the day when you face reckoning in terms of the rate story around the world from the Federal Reserve? There's one stock which is absolutely resplendent in the United Kingdom. Anna has just finished a conversation with the CEO of Lloyd's. There's a fragility to the UK, to the economy. House prices are down, but he expects those house prices drops to end next year. Miners are also lower. You're seeing Rio Tinto profit slide and cutting the dividend. So that boom bonanza of the commodities boom in the reopening of China just has not played out as expected. I want to show you Rolls-Royce. They raised the guidance on their profit on surging travel demand. They've got to repair those engines. That's the point that Anna made just before we came off air. Look at this. The first half year profit will be £680 million, twice the estimate. And the full year will be materially above expectations at 1.2 to 1.4 billion. And the defense business, there's money in war. Defense business will report a 38% increase in operating profit to Rolls-Royce, the engine maker, not the luxury car maker. We're going to keep an eye on tech. We'll check those prices a little bit later on. Across the assets, the field of dreams may be shattered today. We're expecting what kind of a hike? 25 basis points, a 22-year high from the Federal Reserve. However, will it be a hawkish hike or a dovish tone and intonation from Powell? There will be no new dot plot. CPI in Australia comes in a little bit lower, putting the pause factor back on the table for Australia, down 0.3%. NYMEX crude drifts off by 0.1%. We wait for the inventory data later today. And the euro, what the heck? Why not? Because if it's a hawkish hike from the Fed, it may imbue a sense of revival in the dollar and perhaps injurious to the euro. Let's see how the day plays out. As I say, the main course of the day is the Federal Reserve policymakers poised to hike interest rates to the highest level in 22 years. Joining me now is Eddie van der Belt. He is our Markets Live team. Fine, one more and done, but then can you explain to me why the market thinks we're going to get 130 basis points of a hike from top to bottom by the end of next year?
Yeah, look, so this meeting is baked in, as you say. We know what's coming. We know what the Fed's going to do. There's little surprise that they're going to give us. But looking beyond that, the market is looking at something like a 50% chance that there's one more hike coming in November. And then beyond that, the market is expecting cuts. And the market is expecting cuts because they think the Fed has already gone too far and won't be easing early enough to take the pressure off the economy, and that we're going to start to see a U.S. recession, as early as late this year or maybe next year. Now, there's a real question about that, and also about just how much other central banks, like the ECB, will be able to resist a Fed that turns more dovish later in the year. Because at the moment, the expectation is that the ECB remains quite hawkish, remains, keeping the fight on inflation. But with its economy softening it as well. I think there's an awful lot to play for at this meeting.
What do you trust more? Because I see two very different messages coming towards me. I've got consumer confidence at a 2-year high in the United States, with the Philly Fed saying, oh, pay me more, pay me more, pay me more. And then I have the New York Fed, which I'm supposed to venerate in front of the altar of the New York Fed, and go, wow. Recession risk is at a 60%, the 40-year high. Who do I venerate the most, the House of Fed or the House of Consumer?
Yeah, the consumer numbers were quite a surprise. And the consumer has been quite strong through all of this. Now, when we start to break down those numbers, when we look at like PMIs and so on, we're seeing the weakness in the economy mainly coming from the manufacturing sector. And the services sector still relatively resilient, even as we start to see that number creeping closer to 50 and the contractionary levels below that. But I think there's one other thing that I think that we need to take into account, and that is instability in the banking sector. Now, the Fed, the only time that I've really heard Chairman Powell sound quite nervous this year was back in March, when we had the big the big instability in the banking sector. Yesterday, there was with PacWest, we saw the share price fall significantly, talk of the takeover there. And I think if we see a return to those kind of conditions, I think it would shift the Fed's narrative very quickly, and we will start to see cuts follow sooner rather than later.
Yeah, it's almost like it's bubbling below the surface, but yet, the overall index is just pumping away with the concentration in tech. Eddie, thank you very much. Let's see what the evening brings for us. That's Eddie van der Walt, our Markets Live team. So the International Monetary Fund, they've raised the world growth forecast for this year to 3%, up from 2.8%. That they projected in April. Now, the fund's chief economist told Bloomberg that the inflation is still a drag.
The biggest threat remains inflation. We've had some good news on output growth. We've revised upwards a little bit. I mean, there was quite a bit of resilience in the global economy, but especially in the first quarter. But, the momentum is slowing down, and this is why, at the end of the day, the revision is not stronger than what it is, and why we're going into next year also with relatively modest growth.
Anika Gupta is our guest this morning, Director of Macroeconomics Research at WisdomTree. So the IMF, many people deride the IMF as being late to the advisory party in the upgrade to growth. But Anika, I said to Eddie, I venerate the House of Fed in New York, which says the probability of a recession at 60% at a 40-year high. Or do you put your trust in the consumer, where consumer confidence is at a 2-year high? Who's right?
A very good morning, Manus. I do put my trust in the consumer because that's the part of the economy that has been most resilient, and that has been, hiding the disparity between the, strong activity data in services amidst the, weakness that we've seen within manufacturing. So I think what did come to light in the IMF report is they have seen some strong economic momentum coming in from most of the developed parts of the economy. That's clearly been quite helpful. but that there is a clear, disparity that we're seeing between manufacturing and services, and rightly so, because the effects of monetary policy are slowly being filtered into the economy, and that transmission is taking place, and that's what we're seeing play out within manufacturing.
And I think that was demonstrable yesterday when we had the EFO president with us, and that huge drop in bank in demands from corporates, from the banks, a record drop in demand. When you look across to the USA, rates we expect to hit a 22-year high tonight. Do you think it's prudent that Powell indicates pause, or must he go for the hawkish hike to sustain his optionality?
Well, I think that he's most likely to go for more of a hawkish hike. And the reason for that is, on one end, if you look at economic surprise indices, the US has been the most resilient. So when you compare the US to Eurozone and China, the US economic activity surprises have been doing a lot better. So the US is faced with a situation where they have been bringing down inflation. It's around 3% now, much closer to the Fed's target compared to the Eurozone, the UK. And that is coming against an economy that's fairly strong. So yes, as we move ahead, we're likely to see the U.S. economy slow down. But they have made progress on two fronts. The growth is fairly steady. Inflation is coming down, and hence I think he's going to keep it open to being quite data dependent based on how the progress moves as we move into year end.
Now, look, central banks never talk about currencies, and they deflect and rarely refer to them. I look at the dollar, it's obviously retraced significantly in this first 6-7 months of the year. Do you think that that's, as it were, doing some of the lifting against 5.5% rates for the Dow, the broader bulwark of the United States of America? It's on a winning tear, one of the strongest that we've seen for a number of years.
It's a very interesting point you've raised, Manis, because what we have been seeing in the Eurozone is the strength of the euro versus the US dollar is now becoming quite an important concern for the doves on the European Central Bank. So I think that is another factor that they will take into account, as it's clearly going to make imports coming in a lot more cheaper. Yet at the same time, it's going to make their exports, which is very important for the Eurozone economy, a lot more expensive. And that could be an important headwind for growth. So I think the ECB is taking note of that. We have seen recent talk of the doves paying a bit more closer attention to euro strength.
Okay, well, we'll pick that up in just a moment. We're going to continue the conversation on Europe, and as you say, perhaps a boost for Europe. Let's see what the dollar's drop has done elsewhere. Anika, stay with me. Anika Gupta, Director of Macroeconomics Research over at Wisdom Tree, our guest this morning. Coming up, European banks, they post their earnings. We'll bring you the very latest on the likes of Lloyds, Santander, Deutsche Bank, and UniCredit right here on Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
We've had a slew of bank earnings this morning. Lloyd's posting a miss. Deutsche delivering a beat. Lloyd's, of course, the CEO was with Anna just a few moments ago saying the fragility in the UK is going to limit growth. Deutsche is down by 0.6%. I mean, if you think about it, and you've got UniCredit. By the way, UniCredit up 1.7%. They've raised the full year target for the year. They are the top performing stock in the banking sector, up by 70% this year. Santander, of course, up 26% as well. Deutsche did a buyback, but there's just that lack of belief in the velocity for the rest of the year. Let's get to Bloomberg's Andre Yusen van Vieren. He is with us on the bank. So Deutsche, good set of numbers ahead of the estimates, and yet the stock's down. Why?
Morning, Manus. I think, as you say, it was a good set of numbers. We had the 450 million euro buyback that Deutsche released yesterday with promises of more to come. We've seen fixed income trading revenue that were down, but still better than what was expected, and also ahead of most of Deutsche's rivals on Wall Street. So yeah, as you say, why is there that lack of belief? I think maybe two items to flag. Expenses came in higher. That was due to redundancies and litigation, and also there's also that sense that the initial boost from higher interest rates are starting to wane.
Yeah, I mean, Santander has the breadth of reach, haven't they, into Brazil and Chile. Andre Orchel must be the smiling man of Europe. I mean, can you imagine his options and what they are worth? To be the CEO of UniCredit. What conclusion do I walk away from today?
I think, first of all, maybe just first, if I look at Deutsche Bank, for instance, again, I think what will be interesting is to see his guidance just on how, on interest margins. We've already seen that being flagged by Deutsche, but if you look at sort of like the likes of Santander, a retail bank, it's just to what extent are the tailwinds from rates holding up? In the case of Santander, we've seen that they're still benefiting to what extent, to a big extent. But we may be looking at guidance about whether those margins may be closing, to what extent banks will need to pay more for their deposits, and also to what extent demands for loans are falling, and provisions that needs to be made.
Well, that demand for mortgages imploding yesterday, and demand from companies under pressure. Andre, thank you so much. That's Andre Yusen Friefin, our resident reporter on banks. And Deutsche Bank weathered the trading slowdown better than analysts had expected. The CFO, James von Moltke, spoke to our very own Oliver Crook on the earnings and the outlook for Germany.
It's sort of a mixed picture, as I said earlier, but in part what I mean there is Germany and Europe more broadly has been somewhat stagnant in terms of its growth these past several quarters, sort of at around zero. We do expect that to be a little better in the second quarter, but what you're seeing is the effect of certain sectors, so building, for example, and real estate being in a recessionary territory. other sectors like services, growing quite strongly. So there's a mix going on. And to your question, what is the dynamic going forward of recovery in those areas that are recessionary? What's going to happen with sort of the industrial order books and the export market? All of those things are in play. But I think the conditions are in place to see sort of steady growth starting, either late this year or into 24.
And just very quickly, because we have not much time left, when we just think about the balance of risks for clients, what are they most worried about now? Originally, is inflation, then recession, then kind of geopolitics. What do you think is the kind of guide right now is preoccupying?
Look, I think geopolitics is front and center. I think, as I say, I think the direction of rates probably more clear. People are getting more comfortable with the direction of the economy, and that really leaves sort of geopolitics as the big unknown that we're dealing with. So as more of these clouds begin to clear, as I say, the conditions are there for a growing economy and a normalized rate environment, which should be good for the banks.
Deutsche Bank CFO James von Moltke there speaking to Oliver Krupp. Anika Gupta is my guest, Director of Macroeconomic Research at Wisdom Tree. Yesterday, 24 hours ago, I brought our viewers this chart, the change in credit demand for residential mortgages and demand for credit from companies. How fragile a moment is this for Europe?
It is a difficult moment, Manus. We're seeing activity indicators are coming down. Just this week we've seen PMI data for manufacturing, especially in Germany, being quite weak. But I will, if you recall, at the turn of this European rebound cycle that we did get, we had PMIs coming down to extremely low levels. So I think we would discount some of that information coming out from the PMI data and give a bit more credit to the hard data that's coming in for the Eurozone economy. Even if you look at the European consumer, is still sitting on excess savings that haven't really been wound down as it has been by the US consumer. And in addition, I think another factor that's boding well for Europe is we are seeing inflation coming down. And from an income perspective, that should also be beneficial for the European consumer.
Anika, let's see how we bear up through the second half of the year. That is Anika Gupta, Director of Macroeconomic Research over at Wisdom Tree. Coming up on the show, Danone sale beat estimates. The shares drop as concerns remain over the company's turnaround plans right here on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names stories that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology. Welcome to Balance of Power.
This is Bloomberg.
Welcome back. Danone topped its estimates. The shares, however, are lower this morning. We've got concerns around the company's turnaround plan. The French yogurt maker is taking a 200 million euro impairment on its assets seized in Russia. Let's bring in our reporter. It's Dasha Afanasieva. Dasha, so the results, they just didn't do as well as Unilever. And in this earnings season, you gotta deliver.
Absolutely, and especially if you have an environment where you are increasing prices by a lot and you're setting your, your sales target at reasonably low, you've got to deliver and you've got to show that particularly the biggest division, which for Danone is the yogurt unit, is experiencing a turnaround. But what actually happened is volumes in that division fell more than 3% in the quarter, which really asks questions about Danone's ability to persuade the consumer to pay premium for these branded products instead of just buying your regular supermarket yogurt.
Yeah, it's convincing us. I mean, the price of yogurt here, I'd make you cry if I told you the price of a pot of yogurt. Impairments in Russia, it's costly getting out of it. Briefly, the size and the impact.
So there's nothing too new in the sense that we already knew that they take an up to €1 billion impairment. But I think it's just a real headache because Danone's now saying, that we do actually own this division that's been seized from us temporarily. There'll be legal ramifications when they sort of try and get damages back, I imagine. And in the meantime, they're trying to stay in contact with their 8,000 staff over there, and it's a really difficult situation.
Indeed. Dasha, thank you so much. Dasha.
Thank you.
Afanasieva, our reporter on the latest from Danone. Tech earnings. Are you bid or are you offered on Alphabet or Microsoft?
young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Fed is poised to hike interest rates to the highest level in 22 years. It will be the 11th increase since early last year. US futures and European stocks remain mixed. Banks Bonanza UniCredit rises as profit surges. Deutsche Bank and Santander beat estimates while Lloyds misses its mark. Plus, NatWest CEO Alison Rose resigns following a row over the way the bank closed accounts held by the politician turned pundit Nigel Farage. A very good morning. It's The Pulse. I'm Manish Krani in Dubai. It will be a pivotal week for tech stocks. Alphabet stock, let's just check in on how we're trading pre-market, because apparently we are still Googling. Alphabet shares are up on some news that ad trends are doing quite well. So you've got Alphabet up 6.63%. The cloud unit had its second profitable quarter, $395 million. That's more than the market had anticipated. We are Googling. Of course, they own Google rather than ChatGPT. And you've got Microsoft. Now, Microsoft, on the other hand, sees a deceleration in their cloud demand. So somebody's winning the battle for cloud. We'll ask Aggie Cantrell in just a moment why the divergence between the two. Those are your pre-market checks. Shall we get to Aggie? I know that there is a little bit of breaking news, Aggie. I know you love an apparel spritz or a light Negroni. Shall we do that just before we talk about tech? Campari, first half sales, 1.46 billion. Pretty much in line with what the market had expected. Yes, there are veteran Negroni drinkers on this show, and there are veteran apparel spritz drinkers. So we'll bring you more on Campari in just a moment. The resident Italian is out. Ms. Flacqua is somewhere on a beach in Italy, I understand, probably with a Negroni in hand. Never too early for a Negroni. Let's talk big tech. Aggie is patient. She's there. Aggie Cantrell. Talk to me. What's going on with Alphabet and their earnings? I mean, the cloud is doing fine, and apparently we're Googling.
Yes, so with the cloud first, they turned a profit for the first time last quarter in this business, and that seems to still be a sustained thing. That wasn't just a fluke. The Google Cloud is still behind Azure, behind Microsoft, and behind Amazon in terms of its sales, but they do seem to be actually building a really strong business there and managing to turn a profit. But also, what is really interesting to me is the fact that all of this noise about how Google is not going to be able to stand up to the potential of ChatGPT and the investment that Microsoft has made in OpenAI and applying that AI search into its platform Bing, that's not really holding up. When it comes to advertising spend online, Google search is still the core focus. Google search is still dominant, and that is still the focus for this big tech company.
And then Microsoft, on the other hand, I think the word that we're using is tepid sales growth for the quarter, and the company ready to cash in on its AI investments. And I think BI said, look, it's actually better positioned than other cloud providers to monetize. Why?
Yes, exactly that reason. Microsoft has made this play. They were really the early initiators of this original AI hype when they put a 10 billion investment in OpenAI. That was their move that they said was clearly part of tying these AI capabilities into their suite of tools, into their Microsoft tools, and also into Azure, into their cloud service. But when we're seeing the initial cloud growth, that does, as we have referenced in our stories this morning, we're talking about tepid sales. It doesn't mean that they're really struggling. It just means that maybe they really haven't tapped into the full potential of this AI investment in this current quarter. But there does seem to be a likelihood that they will be able to gain that investment going into the following quarters this year. And so it's really a longer term play. And I think that that's what people were wanting to know more about when going into these earnings is, okay, you made this massive investment. Now, when are we actually going to see a return on that?
Aggie, thank you very much. Aggie Cantrell there with the very latest on the tech earnings. And of course, that it comes down to the breadth of the market. The rally in the S&P 500 and in the NASDAQ being driven in large part by a small and coveted group of stocks. Just to recap then, Campari, first half sales coming at 1.46 billion. That's pretty much in line with what the market had expected. I think, however, what you have here is just a little bit of an initial reaction. Maybe there's disappointment that they didn't just deliver a little bit more robustly than was originally anticipated. So we keep an eye on Campari, and we'll come back to that in just a moment. Now, if you are in the mood for a luxury watch, we track them. We keep an eye on them. We've actually got the 60 most traded watches of the top 10 brands. And what you are just seeing is, well, this is the export chart in terms of what's coming out of Switzerland. They just can't keep up with the demand, really, for Rolex, Patek Philippe, and Audemars. So what we are seeing is 60 of the most traded watches in the world. Prices are actually down by 5%. That's the point that we have here. And we know from Louis Vuitton, aspirational luxury is under pressure. So you can see there the exports are booming, but there you go. Prices, they are dipping ever so slightly, but they're still above the actual retail price in the shops. Now, speaking of aspirational luxury, this was a pressure point for LVMH. Sales declined in the second quarter, a sluggish economy, deteriorating issues, and I suppose deterring some of the shoppers from buying the higher-end products. That offset with the sales rebound in China. Let's get to our Bloomberg opinion columnist, Andrea Felstead. Andrea, I love this. I mean, I'll get to the aspirational luxury person in a moment. I think I fall into that rather than true wealth. Is the luxury boom near an end?
It's not ending, but it does look like we are moving to perhaps a slower rate of growth, a more normal rate of growth after the very elevated levels of demand we've seen for the last 3 years. As we came out of the pandemic, we perhaps couldn't travel as much as we wanted to, so we splurged on things like watches and handbags.
Yep, that revenge spending may well be coming to an end. I think that was the guidance, wasn't it, from the CFO there. But what do we learn more about the US and China? Maybe this is where the aspirational group come into play. I wonder what price aspirational shoppers run out of puff at. Is it a couple of thousand, 3,000, 4,000? I don't know. What is an aspirational shopper?
Aspirational, when it comes to handbags, aspirational is generally regarded as under $1,000. So that would be perhaps some, lower end Gucci, Burberry. They are certainly the brands that have been most affected by this. Many of the luxury brands have been elevating their prices, which in turn does take them out of the reach of some of these aspirational shoppers.
Yeah, well, Christian Dior, what managed to put on another 4% on prices just there in July. Andrea, thank you very much. Keeping it real for the aspirational shoppers and beyond. Andrea Felstead, our Bloomberg opinion columnist, coming up in this show. Now we're CEO Alison Rose stepping down just hours after receiving a full confidence vote from the board. The controversy explained involving a politician turned pundit, Nigel Farage, and his exit from the private bank at NatWest, right here on Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Season is here.
Decent start to earnings season. We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust. ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
The ECB is still catching up.
They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Most questions will persist up until Lagarde goes on that podium.
Coverage begins Thursday on Bloomberg, your global business authority.
NatWest is falling this morning after the CEO, Alison Rose, stepped down following a row over the way the British lender closed Nigel Farage's bank account. Rose resigned after she admitted leaking information about the politician turned pundit to the BBC. The leak related to Farage's status as a customer of Coutts Bank, which caters to some of the UK's wealthiest people, including members of the royal family. Let's bring in our very own Will Shaw from the finance team. So this is a pretty damning moment for the bank in terms of, will CEOs want to talk to journalists ever again? Alison Rose has had to go. Was it political pressure that was brought to bear rather than the board?
It appears certainly that was the case. And this looked, I think with hindsight, this now looks like it was inevitable that Alison Rose needed to go. However, it didn't look inevitable to NatWest until it was actually happening. So shortly after 5 yesterday, NatWest issued a statement in which Alison Rose was quoted. She admitted talking to a BBC journalist about the reason for Nigel Farage's account being closed. She apologised for that. She said at the time she believed that, yes, it had been done for commercial reasons, and she hadn't seen the internal documents from Coutts that suggested that Nigel Farage had been ditched because his values weren't compatible with those of the bank. The chairman of NatWest, Howard Davis, in the same statement, said, yes, there'd been an error of judgment, but the bank still had confidence in Alison Rose. Then everything went silent for a few hours, and at about 1:30 in the morning, London time last night, the story reopened. There was another statement from NatWest saying, in fact, Alison Rose will be leaving by mutual consent. Now, the political backdrop to this is obviously very important. As everybody knows, NatWest is still largely owned by the UK government. They have about 39% of voting rights in the bank. There are a lot of people within the government that share Farage's opinions and worldview. Now, people close to the Prime Minister and close to the Chancellor last night were briefing that Alison Rose's position wasn't sustainable and that she would need to go. So effectively, yes, it was an inevitable decision. It was influenced heavily by politics.
Well, the UK remains NatWest's biggest shareholder for about 15 years. I'm just looking at it here. So, of course, they will have a discourse, if not an influence. Do you think it's resolved the matter? Do you think we're going to have a committee hearing in Parliament? Do you think that they'll be called before Parliament to discuss this?
Well, Nigel Farage has certainly called for an inquiry in Parliament. I spoke to him this morning. As far as he's concerned, this matter isn't over. He would now like to see Coutts CEO Peter Flavel stepping down, and even Howard Davis, the chairman. He says he's written to Peter Flavel 3 times and received no answer. And on Howard Davis, he says Howard Davis is essentially responsible for governance at the bank, and the governance systems have failed. So I don't think that necessarily this is over at this stage.
I suppose then what next for the leadership? We have an interim CEO?
Yeah, so there is someone stepping in for 12 months to run the bank while they decide on a more permanent appointment. Separately, in light of this, the government has indicated that it will be pushing for reforms to prevent this from happening again. Even Rishi Sunak has weighed in. He said it's not appropriate for banks to be closing people's accounts simply for expressing their opinions within the confines of the law.
Okay, well, let's see where this rumbles on to. How many more scalps will there be had before this lies low? Will, thank you very much. Will Shaw in London. So the decline in Israeli assets continues. Investors' concerns grow over the law that weakens the power of judges, which has sent hundreds of thousands of people onto the streets. The Israeli stock market is on the move again today, recovering ever so slightly. You can see the stocks fell by 3.7% yesterday, rallying by 1.5% this morning. The dollar continues higher, the shekel lower. This will be the 5th day of a move like that for the shekel. So the pressure's coming to bear and yields tick slightly higher. Inflation could be the result of a weaker currency. That was one of the sentiments that came through from a conversation that we had here on Daybreak Middle East and Africa. I caught up with the former governor of the Bank of Israel, Karnat Flug. She's hopeful that strong market reaction may prompt the Netanyahu government to review its judicial overhaul plans.
I hope that maybe now with the very strong reaction of markets and of the streets, of the protest, maybe there will be a revision of thinking about what should be the next step. And I very much hope that any next step in the legislation will actually take all these very negative effects into account and will not move forward without a very broad agreement and broader consensus that should underline any change, very fundamental changes in the system.
We had a guest yesterday that commented on Biden's intervention, late-night intervention, the evening before this law was passed. And he said it's unusual for the U.S. to comment on domestic internal events within Israel. Criticism is easy and fair, but not on domestic issues. When you look at this criticism from the U.S. and other nations around the world, how deleterious is that to FDI, to global companies, global tech, saying Israel is hot on my list? Does it move off the hot list as a tech destination with this political shift at the moment?
Yeah, I think this is really one of the strongest channels by which this judicial overhaul is actually affecting the economy. We've seen a decline in the investment in the Israeli high-tech much beyond what happened in other high-tech sectors elsewhere. And we haven't seen the beginning of a recovery that we've seen elsewhere. I think the Israeli economy is more susceptible to this kind of changes because of its dependence on the high-tech sector that had been an extremely important engine of growth. It's a very important source of revenue, of tax revenue. It's more than half of our exports. And I think that's why we really have to be very careful in making steps that are causing concern among investors in actually investing in our high-tech sector.
That was the former governor of the Bank of Israel, Conor Fluke, speaking to myself and Yusuf Gamal Al-Din a little bit earlier. She did warn a weaker currency delivers higher inflation. Higher inflation could undo all of the good work that the Central Bank of Israel has done, and therefore could put rate hikes more materially back on the risk-ometer. Coming up in the show, it is Fed Day. We have a decision ahead of us today with guidance. The U.S. is set to see the highest interest rates in 22 years. What will Jay Powell deliver in the narrative of forward guidance this evening?
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Of the 90 largest economies on the planet, 60 are companies and 30 are countries. So does corporate world have something to do with it? Absolutely. And I think real leadership at the corporate level is a huge part of the solution. So I feel like part of my job is encouraging corporate leaders to make these investments. And it's not just sustainability, it's not just making sure that your footprint of your company is net zero. It's making additional contributions because biodiversity, there's no market for pandas or frogs, we still need to protect them.
Does climate change have a PR problem in 2023? Should we call it something else so that we act quicker?
I think so. I think climate change makes you think about something that's in the future, something that's polarized. What it really is, it's a carbon pollution problem. And we have an excess of carbon in the atmosphere, and we need to get rid of it. That's simple as that. It's killing our children, it's killing the forests, it's killing the ocean.
And you can see the full interview with the photographer and conservationist Christina Mittermeier on Leaders with L'Aqua Goes Green. That airs 9:30 p.m. New York time tonight in the US and 6:30 p.m. in London on Thursday. So are you ready? you ready for rates at a 22-year high? You haven't had much volatility getting there, really, have you? 4.85% is where we are on the 2-year. There will be no dots. There will be verbal guidance. The Philly Fed is flashing pay rises for all, my friends. The consumer is strong at a 2-year high, and the New York Fed is indicating the risk of a recession is at a 40-year high. What's not to love about treasuries? How to protect yourself in the hubris of the debate about where the U.S. economy goes. What better lady to do it than Valerie Titel? She joins me now. Valerie, come on. Is it one more hike and done?
Look, Manus, that's the question everyone wants to know, but the problem is we're unlikely to get an answer tonight. It's upsetting, I know, Manus, but really I think Powell's going to keep his cards close to his chest. He has really nothing to gain from talking about a hike in the next meeting, or perhaps maybe conceding a big win on that inflation print 2 weeks ago. We've got a long stretch of time in between this meeting and the meeting in September. It includes 2 CPI prints and 2 NFP prints. He's really unlikely to give any strong guidance on what's to come. I want to go over this chart quickly because I think it's important. It goes over how the change, or how the front end pricing has changed recently. As you noted, Manus, we have had a lot of good economic data in the U.S., and that has seen the pricing for another hike creep up slowly. And it was that consumer confidence data yesterday we got, Manus, that showed consumer confidence rising to a 2-year high that is now putting the pricing for another hike post-July later in the year at 50%. This is going to be the key thing to watch. I think Powell's going to be pretty happy with this pricing. He definitely wants some positive term premium after this meeting. He wants that threat of additional hike to be taken seriously by the markets. And at the moment, it kind of is.
I actually walked past the New York Fed the other day in New York. I sort of walked past and went, oh, there it is. I venerated that rather than the consumer. Now, what else is going to shake the boat if Powell doesn't rock the boat tonight? What's on the horizon to shake the equity? Briefly, 30 seconds. Take it away.
It's not all just about the Fed. We've got a big slice of data coming this week. On Thursday, we get the first reading of the second quarter GDP. That's going to be one to watch alongside durable goods. Friday, PCE, the Fed's favorite measure of inflation, comes alongside the employment cost index, which is their also favorite measure of wage inflation. And then next Tuesday, we get the big ISM report, including manufacturing and services. Doesn't reflect the same picture as the PMIs, that manufacturing was rebounding. And this, again, maybe could push us to all-time highs. They are in sight, Manus. How exciting. The S&P 500 is now within 5% of those all-time highs from January 2022.
I'll leave you with this thought, Valerie. The higher that goes, the closer I am to sustaining that retirement fund. All eyes down. I've got a little bit breath left in me to go. I'll leave you with that thought. Surveillance. The early edition's up next with Kriti Gupta in New York and Danny Berger in London. From Dubai, good morning, good evening.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Caution prevails as investors reduce risk ahead of the Fed decision. Policymakers are ready to hike interest rates to the highest level in 22 years. From tech to autos, earnings season is in full swing. We're going to break down the latest AI hype from Alphabet and Microsoft, plus speak exclusively with the CEO of Stellantis as cost-cutting lifts profits. And Deutsche Bank weathers the trading slowdown better than expected, while NatWest CEO Allison Rose resigns following a political controversy. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, it says a lot when the Fed is the least interesting story. Before anyone gets mad at me, of course, is important, but look, it's not the most volatile, surprising thing we've gotten today.
No, it isn't, but I'm sure it will be in a couple of hours, certainly as we're watching the bond market really position for that. Remember, look, 25 basis points is what's on the table here, priced into the market. The big question is what kind of precedent does it set? Because remember, Goldman Sachs specifically coming out and saying that their house call is essentially that the Federal Reserve is going to alternate between a pause and a hike. We're on the hikes turn. Do you start to see Chairman Powell say, we might need to pause yet again? That's going to be really the sticking point when it comes to what the Federal Reserve is thinking, in addition to all, of course, their macro feedback. The way it's translating to the market this morning, though, really has more to do with earnings than it has to do with the Federal Reserve, specifically NASDAQ 100 futures, of course, coming off of the Alphabet and Microsoft earnings, down about 0.2%. But remember, there was this big buildup going into those earnings as well. So how much of this, Danny, is positioning, of course, as we are in the last week of the month as well. So some rebalancing flows there to keep in mind. Two-year yield, 485, again, ahead of the Federal Reserve, down about 2 basis points. So you are seeing the bond market catch a little bit of a bid, at least on the front end of the curve, a smaller bid as you go further out. Perhaps taking with it the dollar as well. You are seeing some broad weakness in the dollar, but a good chunk of that is coming from strength in the Japanese yen. Now, remember, we are going to hear from the BOJ later this week as well, and that is going to be crucial when we talk about how they're going to perhaps follow up with their yield curve comments earlier this week, front-running that a little bit. But nevertheless, dollar-yen weaker by about 0.4%, 140.34 on that currency pair. And of course, gold. What's interesting here is that as yields are coming down, gold is actually higher. So how much of this is a kind of store of value trade, Danny? 1972 on the precious metal.
It does feel like it's summer markets, which, to your point, Kriti, makes today's decision by the Fed even greater chances of volatility. If we're not seeing tons of volume coming through, that's especially true in Europe. Not a lot of excitement. The euro is barely changed, just slightly stronger versus the dollar. The excitement, Kriti, it's all under the surface. It is all about earnings. I picked out two specifically for us because they're one of the biggest movers to the upside and downside. The biggest mover to the upside in the Stock 600 this morning is Rolls-Royce. They, of course, no longer make cars. This is the engine maker. Good news for them. They're able to lift their profit forecast because we're all traveling. Sure, there's concerns about European consumers, but we're happy to pay up to go on flights still. So Rolls-Royce up some 20%. It's its highest level in about 3 years. Meanwhile, one of the biggest losers to the downside, and it's absolutely the biggest loser if you take into account market cap, is LVMH, falling almost 4%. Their earnings were after the bell yesterday. The big disappointment was the American customer. Those organic revenues falling 1%. Kriti, we established you didn't buy Van Cleef, you didn't help out Richemont. What's up? Are you not buying Celine either? You and your American friends not helping LVMH out.
I know, it's almost like we have to deal with inflation and a lower real wage. It's pretty astonishing. How dare we not help out those luxury brands? But let me tell you, there are going to be a lot more movement from perhaps some of the bigger players, not just in the consumer space, but in the corporate space as well, which brings us to Alphabet and Microsoft reporting their second quarter results, both focusing on the growth of AI. Take a listen to what Alphabet CEO Sundar Pichai said on the earnings call.
We are making sure we develop and deploy AI technology responsibly so that everyone can benefit. Last week, we signed on to joint commitments with other leading AI companies at the White House, building on the principles that have guided our work for many years. To take advantage of the AI opportunities ahead, we've been sharpening our focus as a company, investing responsibly with great discipline, and finding areas where we can operate more cost-effectively.
Joining us now is Matt Bloxham of Bloomberg Intelligence. Look, perhaps some differing messages when it comes to Alphabet versus Microsoft. Matt, I want to start off specifically with the Alphabet story here. Talk to us about what we learned. What was the most surprising to you?
Well, I guess what was maybe surprising but encouraging to investors was that there was strength across the whole suite of revenues, and in particular their search platform, which is the core of everything that Google does, surprised to the upside. You know, there's strength in the advertising market for them. Things like the ChatGPT haven't really yet made any inroads into that core business. And I think it also speaks to how brands think about advertising. You know, in an environment where they're having to cut back on budgets, they still stick with the platforms that they know and trust to deliver them results, and Google Search is very much that platform.
Yeah, short Snap advertising, long Google advertising is what these earnings feel like. What about Microsoft, down 4% in the pre-market trade? Is that more about the stock price run-up more so than the actual results?
I think so. I think it also does speak to this kind of hype around AI, and the reality is it's going to take quite a few quarters for the AI revenue growth to really kick in. And so as they announced last week, these new Copilot products for Microsoft 365, so AI extensions to Excel and Google and PowerPoint, things like that. But it's going to take a while for that to kick in. And there's also, in the interim, there's going to be more investments into their cloud infrastructure to make those services possible. So I think it's kind of patience for investors before you see those revenue benefits start to kick in.
Yeah, and I wonder how much of this was really traded ahead of time as well. We were kind of expecting a little bit of doom and gloom from Microsoft. Perhaps we got that. Matt Bloxham of Bloomberg Intelligence all over the big tech story. And of course, we go from big tech to banking. Over in Europe, Deutsche Bank kicks off banking earnings, beating expectations amid a trading slowdown. The lender announced a share buyback of as much as 450 million euros. Bloomberg's Oliver Crook spoke with the CFO.
First of all, in our range, which we said at the beginning of the year, 28 to 29 billion, we're now saying that we think we're solidly in the middle, probably the upper end of that range. We think there's a story developing in terms of the non-interest income revenue sources that we have. You know, financial markets over the past, 4 or 5 quarters have been sort of more difficult, but we see that starting to come back, and we think we're very well positioned to take advantage of that.
Oliver Crook now joins us from Frankfurt. Oliver, talk us through the results here. Deutsche Bank, of course, not the only one reporting this morning, Santander as well, but talk us through what you learned here from the Deutsche story.
Yeah, Kriti, overall, pretty positive earnings story here from Deutsche Bank. Let's drill down a little bit into the different categories. Asset management, private bank, both sort of in line. And the corporate bank and critically, the investment bank beating expectations. Remember, FICC and trading in particular was going to be the focus here. They had guided it down up to 20% lower this quarter. Goldman Sachs had an estimate down 18% for Deutsche Bank. It came in down only 10%. So that is really sort of a standout beat there, beat a lot of the peers. And what's also interesting is seeing the balance of the business shifting through the interest rate hike environment. You actually had the private bank bring in more revenue than the investment bank. All of this being said, it is not enough for investors this morning. It's down about 1%. That down probably to costs coming in a little bit higher. They're aggressively cutting costs, and maybe that's going to be a little bit more challenging than they had anticipated.
Oliver, we also had some really ugly numbers from Germany, from the German eco story. As an executive who oversees Deutsche Bank, I mean, the German bank, what did you have to say about that in the broader European economy?
Yeah, listen, this is all down to it's a rate-sensitive business, and obviously this is a rate-sensitive economy like every economy. And really, as the lender to Germany Inc., there's been no shortage of bad news, whether it's PMI, IFO surveys, these GDP revisions in and out of recession. Basically, I asked him about that, and yesterday we had the ECB saying that corporate loan demand fell off of a cliff, and he's seeing that in the results. He's seeing that in terms of demand. However, he still believes in the soft landing narrative. He says that is to be expected. Credit conditions he's actually okay with, all things considered. He says there are pockets of weakness, but it's not broad-based, and he does actually expect growth to pick up in the back half and the end of the year. What clients are most worried about, it's no longer inflation, it's no longer recession, it's geopolitics.
Oliver, thank you so much. A really fantastic interview. Bloomberg's Oliver Crook in Frankfurt. In other banking news, NatWest CEO Alison Rose will step down following a row over the way the British lender closed accounts held by politician turned pundit Nigel Farage. Pressure for her to quit had been rising. Both Rishi Sunak and Jeremy Hunt indicated her position was untenable after she said she spoke to a BBC journalist about the account closures. Let's bring in Bloomberg's Will Shaw for more on this. Well, when I went to sleep last night, it seemed like the board was backing Alison Rose. What happened? What made things turn here for her?
Oh, it was all very strange, and it all happened very quickly. So shortly after 5 p.m., NatWest put out a statement in which she acknowledged having spoken to the BBC about Nigel Farage's bank account at Coutts and why it had been closed. She apologised for that. She said she shouldn't have done it, but at the time, she thought what she was telling the BBC was correct, which was that this was a commercial decision, and she hadn't yet seen the documents that Nigel Farage has released from Coutts, suggesting that they got rid of him after deciding that his values didn't match their own commitment to diversity. In the same statement, the NatWest chairman, Howard Davis, said he acknowledged that Alison Rose had made an error of judgment, but the bank still had confidence in her. At that point, everything went quiet. People thought, that's it for now, perhaps. Then suddenly at 1:30 a.m., NatWest put out another statement saying, in fact, Alison Rose would be leaving by mutual consent. Now, the backdrop of this is the government remains the biggest shareholder in NatWest. They've got 39% voting rights in the bank. It's a conservative government. There's plenty of people in there who sympathise with Nigel Farage and his opinions. People close to the Chancellor, close to the Prime Minister, were briefing after the initial statement from NatWest that Alison Rose really ought to go. So it's very much a political story.
And of course, stateside, we also have more banking news. PacWest, for example, being bought by smaller rival Bank of California. Talk us through the context of this deal. What was the market response here?
So that merger is essentially aimed at shoring up confidence in US regional banks after a run on deposits caused several of them to collapse. The market is very pleased with this news. Shares in Bank of California surged by some 22% after the Wall Street Journal first reported that the pair were in talks. So obviously, this is something that the market did want to hear.
Will, thank you very much. That is Bloomberg's Will Shaw in London. Coming up, Stellantis delivers better than expected results for the first half and says more cost cutting is to come. We're going to have our exclusive interview with CEO Carlos Tavares next, and we're going to push ahead to the Fed decision That comes later today. Anika Trion, Van Lanschot Kempen, chief economist. We got so much to discuss. Stay with us. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. The market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery. But will it be the last of the cycle?
Is it one and done or more to come? Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. A lot of earnings to sort through, European automakers being one of them. So we had Porsche this morning. It's currently edging lower. It missed on sales. Now, on the other side of things, Stellantis higher, almost 2%. It reported better than expected results for the first half and said further cost-cutting measures are to come. Joining us now is Stellantis CEO Carlos Tavares. Carlos, thank you so much for joining us. Congratulations, a good set of results. The market likes the results. And clearly there's a lot of excitement over cost cuts and that more are to come. Where are you going to squeeze that extra juice from?
Well, first of all, thank you for having me. It's indeed a very exciting period we are going through because not only our strategic direction is proving to be the right one, given the results we are achieving, but we also see that the market is becoming more and more competitive, and therefore we need to be aligning our own business model to what the customers are looking for. They are looking for more affordability, they are looking for less emissions, they are looking for a high level of appeal and a high level of quality. From that perspective, I would like just to point out that in the last GD Power survey results, the Stellantis brands took the 3 positions of the podium, number 1 with Dodge, number 2 with Ram, and number 3 with Alfa Romeo. So we are very happy to move in that direction. And of course, if we need more breathing space to adapt to the market conditions, we'll make sure that we continue to reduce our own costs, to make sure that we give back to the market the level of affordability that the market is looking for from us.
So would you, for example, Carlos, drop suppliers. Is that something you're thinking of if they can't reduce costs to the level that you want?
You know, over the last 30 years, we have given our suppliers 85% of the added value of automobiles. 85% of the total production cost of an automobile is bought out parts. So we have given our suppliers 85% of that added value. Over the last 30 years, they have enjoyed significant profits and good returns for their investors, and that's fine. And we love that. As a consequence of that, it is also true that when we have to absorb 40% of additional costs coming from electrification, their contribution needs to be a reality as much as we are contributing ourselves from our own plants. So yes, at the end of the day, it has to be a partnership working both ways. It is time now to help the US consumer benefit from electrified, affordable solutions, which means we both have to contribute, we both have to find breakthroughs, we both have to work in a more collaborative way to make sure that the final winner is the US consumer with affordable electrified solutions. That's normal, that's the reality of our industry.
So is that a yes, Carlos? You would drop them if they don't do this plan?
It is not what I mean. What I mean is that they need to be taking examples from what we are already doing. What we see in our plants is that the biggest contribution to the cost reduction of our automobiles is coming from our own plants. So we can support them with the open book comparisons in terms of the methodologies, tools, performance KPIs that we are using to help them accelerate their own cost reduction in a win-win perspective. And the point is, in this Darwinian period, if you don't transform yourself, indeed, you put yourself at risk. It's true for us, the OEMs, it's true for the suppliers. This is a Darwinian period. This is a period where if you don't adapt to a new world, a world of electrification, a world of very strong demand from our customers in quality and in a certain number of attributes, if we don't adapt, then we put ourselves at risk. It's not Stellantis that is triggering that. Yeah. Stellantis is adapting to a new world, and we are inviting our suppliers to come along with us and learn as fast as we are learning for ourselves by showing them what we are doing. And that's the direction, the collaborative direction that we would like to take.
Yeah, certainly an approach that I think a lot of the car makers right now are dealing with in the EV space. But Carlos, at what cost here, especially when a lot of the EV plants in the US that Stellantis is building to address that structural change is also not necessarily, according to some, paying wages in the same way that a traditional car maker would, for example. How do you respond to something like that? Is that something you're going to address as you lean more into EVs?
It's a great point, and I think we should answer in two different kinds of ways. One is short-term, the other one is mid-term. Short-term, last year, based on the 2022 results, we paid to our US workers $14,000 of performance bonus. $14,000 of performance bonus. It was the highest performance bonus among the Detroit 3, and we are proud of that, which means that when we create value, we share those results with our employees, and we bring the best performance bonus of the Detroit 3. So we will continue to do that. We'll continue to support our people and make their life better. That's clear. At the same time, where we do this for our employees, we also want to do for our employees all the work that needs to be done now to protect the midterm competitiveness of our US footprint.
Yeah.
And there are a certain number of things that we see in the numbers that we need to do, in quality, in cost, in timing to go to market, etc. So we have our own list of things that we can work on with our union partners to improve the competitiveness of our operations in the US in midterm. So you see, it's a two-fold answer. Short term, we share, we contribute, and we were among the best.
Yeah.
Midterm, we need to work today with our union partners to get that competitiveness. And we have done this everywhere in the world. We have done it in Germany with IG Metall, in Italy with FIOM, in France with CGT. There is no reason why we would not be able to do it with UAW to protect our own employees and improve their quality of life.
Well, Carlos, I appreciate the optimism. I'm so glad you brought up the UAW. We actually reached out to them for a statement, and I'd like to read to you what they said to us. They said, quote, "We encourage Mr. Tavares to come to Detroit and explain directly to his employees how he can justify their receiving a 6% pay increase over the last 4 years while his salary skyrocketed by 72%. Now, Carlos, talk to us a little bit about your response to the UAW. We know that they are also trying to get that equality in cost that you just talked about. What is your response to those labor negotiations?
First of all, being a free man, I don't have to respond to any postering that I could see in the media every day, of course. So please accept that as part of my answer. You know, what I see through my 42 years of experience in the automotive industry is that there is a big difference between the external postering and what is done behind the scenes in the meeting rooms in terms of common work. So I'm not negative. You can have a judgment about what has been said over the last few weeks or months, trying to put pressure on the OEMs. It's a tactic. I can respect that. I'm working for the employees. I'm working for the employees. I'm working to make their performance bonus bigger, and I'm working to make their plants and their engineering divisions more competitive for the midterm and the long term. So I'm working for them. That's my answer. And as long as my salary is 90% based on results, which is 90% variable, that means that if my salary is okay, then the company is okay, and that's my mission. So I'm quite fine with that. And I just would like to challenge my UAW partners to be constructive, collaborative, and open-minded in the discussions we are going to have together. And I'm sure that we can find a win-win for the best interests of our employees.
Well, Carlos, let's then talk about the read-through into the numbers when it comes to your bottom line, Stellantis' bottom line. I mean, at the end of the day, the UAW represents about 15% of your global workforce. If you are looking at those increase in wages as they are looking for, what does that do for your bottom line at a time that you yourself said you're trying to scale up your EV presence, which, as we know, is a costly venture to begin with?
Well, that's exactly the point. You are hitting the nail, which means now you are talking about midterm. So the question is, if we are doing the right things now by bringing those $14,000 in a performance bonus like we did last year and creating a conditions for that number to improve in the future, how do we prepare for that situation to be sustainable within 3 or 4 years? How do we prepare to make sure that the wealth creation within our US operations will be able to fuel that kind of trend? That's exactly what we should be doing, because, of course, any increase of cost has two dimensions. One dimension is a competitive one. How are the costs of Stellantis competitive vis-a-vis the other OEMs in the market? And that's a competitiveness matter for us. And the second one is, does it trigger inflation for the final consumer? Does it make freedom of mobility less affordable for the middle classes? So we have to tackle these things. We could make a short-term decision that has a negative impact on the
Carlos,
jobs and the competitiveness
I love
in the
what you say. I love what you say in terms of this being a Darwinian period. I really think that captures really the essence of what it's like right now. Look, this is a little bit separate, but I happen to be a huge F1 fan. So nearly every weekend I see those impressive Alfa Romeo cars driving around the circuit. And a lot of Americans like me love it too. Why not try to invest more money in Alfa Romeo and really lift it in the American market? Only about a minute here, Carlos, but what are the economics of that quickly?
Well, that's fantastic. Thank you for making that point. You know, Alfa Romeo is a big success since Stellantis was created. We made a huge turnaround of the business model. It's now a highly profitable brand. It's a growing brand, 60% volume growth on the H1 2023 compared to last year. So it's growing, it's highly profitable. We have turned around. We are happy to be in Formula One, and we are going to increase our presence in the US, including at one point in time.
Carlos, unfortunately, we're just out of time. We're going to have to connect on that later. We've got to talk more F1. Carlos Tavares there of Stellantis. Thanks so much. This is Bloomberg.
Schweinart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Schweinart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Caution prevails as investors reduce risk ahead of the Fed decision. Policymakers poised to hike interest rates to the highest level in 22 years. And from tech to autos, earnings season is in full swing. We're going to break down the latest AI hype from Alphabet and Microsoft. Plus, of course, we just heard exclusively from the CEO of Stellantis talking about cost cutting and those labor negotiations. Plus, Deutsche Bank weathers the trading slowdown better than expected, while NatWest CEO Alison Rose resigns following a political controversy. I'm Kriti Gupta in New York with Danny Berger in London. Danny, 30 minutes into the show, can we officially pivot to Fed talk now? And of course, that is coming. It is Fed Day, but it doesn't necessarily feel like Fed Day.
Kriti, why you got to set me up with that? I literally have a board in front of me with all Europe that literally has nothing to do with the Fed. I'll let you pivot to it, and let me take us through the European trade here. All right, euro. Okay, here's maybe the one asset I have Fed related. Euro versus the dollar. Euro is strengthening, maybe a little bit of caution around the Fed. Perhaps we're buying the euro in anticipation the ECB will be more hawkish, which is entirely possible. I don't see why they would do that because the European data has been so bad, but we know the ECB has sounded more hawkish as of late, so maybe that's how you want to position. European equities overall, they are falling, but let me point out the two standout when it comes to earnings. Rolls-Royce, we were just talking cars, Rolls-Royce not in charge of the car company anymore. This is the engine maker, the UK engine maker, really strong results, upgrading their forecast, considering the travel story still going on, still strong. Those shares up more than 19.5% for the most in 3 years. Meanwhile, LVMH, disappointing results, all about the U.S. consumer, organic revenue in the U.S. falling 1%. Those shares down 4%. Kriti, when you take into account market cap, easily the biggest downside mover in Europe today.
Well, all right, you started with the earnings picture. You picked the micro. We'll stick with that, I suppose. NASDAQ 100 futures down about 0.1%. But look, it really is coming as a function of those Alphabet and Microsoft earnings that we got last night. Remember, Meta reports after the bell today, so that's going to be something to watch as well. But look, again, not major conviction here. I think what's important to keep in mind is there was major buying going into the earnings and then perhaps a sell-off after, not really being reflected when you look at the index level. Again, this is where I do think the macro kind of steps in a little bit, perhaps a little bit of a wait-and-see approach in terms of rebalancing, et cetera, as we wait for 2 p.m. New York time today. Of course, the Federal Reserve decision coming out, about 25 basis points expected on the docket. Nevertheless, the two-year yield is lower. You are seeing bonds catch a bid on the front end of the curve. What does that mean in terms of just how close the Federal Reserve is to ending their tightening cycle? Remember, Goldman is talking about pause, hike, pause, hike. Do we see the Federal Reserve follow that call? And what kind of precedent do they set for all the other central banks we're going to hear from in the back half of the week? Nevertheless, 2-year yield 4.85 there, taking with it the dollar as well. The Japanese yen is actually strengthening. We're looking at 140.32 on that currency pair. So the BOJ is going to be in the news and the headlines later this week. And of course, we did hear earlier this week that yield curve control would not necessarily be tweaked. So perhaps a lot of the action when it comes to the yen already baked into the price. And of course, we have to get a quick check on gold, because as yields come down, gold is actually rising. 1971 on the precious metal, a bit about 0.3%. Danny, I wonder how much of that increases or maximizes as we get closer and closer to the Federal Reserve decision this afternoon.
I was really thinking, Kriti, at the start of this week that we should have done a pool to make bets for all these different central bank decisions, but it kind of feels like all of them are really set in stone. We expect the Fed to go 25 basis points today. It'd be strange if they didn't. Option markets at the moment, it's all about what happens after that. They are pricing in a 50% chance of another hike post-July. I mean, we're dead split, but we also have to remember, Kriti, that it's not until September that we're going to get another Fed decision. In between that, we have 2 CPI reports. We have a lot of data. I mean, we got PCE at the end of the week today. I feel like there's so much unknown that we're going to have to face, even after we have this Fed decision in hand. Okay, so that's the Fed, of course, and we're going to discuss that in just a moment. And then after that, we have the ECB. So when it comes to the ECB at the moment, Kriti, the way this market is positioned is in euro that just hit an all-time high. Very, very recently, we had the trade-weighted euro just last week, had an all-time high. We talked about this dollar net positioning is at its most bearish level on record. You gotta fear it when this market has a one-sided bet on really anything, Kriti.
Yeah, and I think that euro strength that you mentioned is so crucial here, because remember, we are seeing, of course, the talk about the end of the tightening cycle, but at different paces. The Federal Reserve much, much closer to that than some of its peers. Of course, the Bank of England, Danny, you know that. But I think there's a big question here about just how long you see some of the gains or the strength in the currency picture, where all of a sudden, at what point do you see the pivot that the BOE is still hiking, the ECB is still hiking, but that actually leads to currency weakness, not currency strength?
Yeah, look, it's a lot of cross currents to keep track of. I'm trying to keep track of it because, again, I got a wedding to pay for in euros, but I'm paid in pounds. I have some money in dollars. My life is a mess. If anyone has any recommendations, I will happily hear them. Let's listen. Let's now get to someone who knows a lot more than me. Maybe can help me sort out my life. It's Anika Trion. She joins us on the phone, chief economist at Van Lanschot Kempen. Anika, Kriti and I were just talking about the fact that it's not necessarily this decision. It's what comes after this decision that's important for the Fed. But we don't get a dot plot. We don't get a forecast update. So what to you is the most important thing you can learn today from the Fed decision?
Hi, good morning. Well, so I guess the upcoming decision, as you say, is probably going to be a non-event, right? It's already consensual. We'll get the 25 basis points hike, so that will probably happen. But to your point, what happens afterwards? The latest CPI prints being better than expected is certainly helping the idea that we're not going to see lots of additional rate hikes after it. But I think it's all about the following. It's all about what is the attitude and what is the behavior going to be about this official 2% target. Because if you look at the facts, we're still nowhere near the 2% number. Look at core inflation. Look at how sticky it is. Look at how stubborn services inflation is. If the Fed has this attitude that says, look, we've undershot this target for years, and suddenly out of nowhere we're overshooting it, but let's be patient and eventually we'll get there, fine. But if the Fed is going to be very, very strict in order to improve its credibility as well, we're sticking to it and we're going to be extremely hawkish to get there, that could be a negative surprise, and that could trigger the recession that we've all been talking about for so long.
So, Anika, your take then on the Goldman call, which I think a lot of other banks are hopping onto, the pause hike that you are seeing, perhaps expected by the market. What kind of precedent does that set if the Federal Reserve chooses to go in that route for, say, the ECB, the BOE, as they eventually hit the end of their tightening cycles?
Yeah, well, I guess starting with the ECB, so the ECB is clearly behind the curve versus the Fed. And that's also why if you read the minutes and you look at the language being used, Lagarde is extremely outspoken. We are not there yet. Europe has an even bigger, stickier core inflation problem than the US, and that's why there's simply more to go. And even if the Fed is using more of this pause/skip/raise approach, ECB has to continue its trajectory because, as said, we're simply not there yet. The Bank of England, on the other hand, is also, and it's quite interesting because we were all sort of very much aligned with the central banks across the world. Going into COVID, it was all a very negative rate, dovish policy environment. Then after COVID, that got exaggerated, and then suddenly everybody turned around from transitory. And now you see things start to diverge. And maybe it's because the world is becoming less globalized, who knows? But you see that the Bank of England has been pretty extreme. Inflation has been really out of control. The ECB behind that, acknowledging that they've been too slow, and the Fed furthest along in the curve. So it's quite interesting to see how those, and obviously Bank of Japan is a wild card out there, right?
Yeah, it absolutely is. And of course, we're going to hear from them, I believe, tomorrow. Anika Treon, thank you as always for walking us through really the global central banking story. Interesting to see now they're diverging. When do they converge as well? Coming up, we go from the macro to the micro, a tale of two earnings. Big tech posting mixed results. More on that with Stefan Slowinski of BNP Paribas Exane. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, the enthusiasm around AI was really put to the test. We had both Alphabet and Microsoft reporting their second quarter results after the bell. We're going to get a lot more results this week. Here to help us sort through all of them is Stefan Slowinski, Global Head of Software Research at BNP Paribas Exane. Stefan, first of all, thank you so much for taking time out of your schedule to join us. I'm sure this is maybe, the only free breath you can take away from your desk of the day?
Yeah, it's definitely a busy week, but happy to be here. Thanks for having me, Danny.
All right, well, let's pick through some of these. Microsoft, those seem to be the disappointment today. Shares falling about 4% pre-market. They had run up a lot because of AI. Would you characterize these results as a disappointment?
I'd say three things about the Microsoft results. I mean, first of all, the results themselves were very strong. 10% revenue growth, beating expectations by a couple percent, 130 basis points better on margin. Core businesses performing well, Office, Azure, Server, Dynamics. But the second thing I would say is the outlook was a bit soft. The Q1 was a bit light. The commercial bookings didn't grow year over year on tough comps. And on Microsoft Azure, that key cloud computing business, the company didn't commit to a reacceleration there and was a bit vague about when we should see that business stabilize. And there was no real outlook given on the top line for 2024. And then the final thing I would say is they're investing in generative AI. And so margins will be flat this next fiscal year. CapEx will be up. And we think CapEx could grow 40%. 40 year over year.
Wow.
So that's going to keep free cash flow flat, and we think that brings down consensus expectations today.
From a macro perspective, investors are really ready to punish companies that have a higher CapEx, that aren't turning around better profitability. Does this hurt them then in the short run? Is this something that the market is willing to punish or not because it's around AI, which is the shiny new toy for the market?
Yeah, I mean, that's right. This will put that resolve to the test. I think investors will look through this. We see the products. We know that Microsoft 365 Copilot is being piloted by 600 customers, is getting good reviews. That will be coming. It should drive revenue growth acceleration in fiscal 25. So I do think investors will look through this next 12 months of investment, but it could put a cap on the stock near term after a very good run year to date.
Stefan, Kriti Gupta in New York, one of my favorite kind of lessons, I think, from Alphabet is that a success of a company is really out there when you're using the company's name as a verb instead. For example, Googling something or using Word. For example, you can't necessarily say that about AI. To what extent are the investments that you are seeing Alphabet or Microsoft invest in AI going to actually give returns? What's the timeline on that?
Yeah, well, one of the reasons we're excited about AI is we are seeing the products already. So this is why it's different than metaverse or blockchain or some other technologies that maybe are promising but are going to take longer to monetize. I mentioned Microsoft 365 Copilot. We know the pricing already. Customers are already piloting it. It should be sold, generally available by the end of this calendar year. Salesforce is another company that we like here. 100% of their revenues should be boosted by generative AI capability. Those products just went live a couple of weeks ago. And so these products are coming live. They should drive upgrades of contracts, in some cases, additional SKUs in terms of products that can be sold. And so, yes, these are big companies. It will take time to come through in terms of meaningful contribution. We think that happens in calendar year 2025 for some of these early movers.
Well, then talk to us a little bit about the antitrust scrutiny as well, because now you're starting to see the AI story get scrutinized, especially in Washington. We already know that things like gaming, for example, have been heavily scrutinized by the CMA and the European Commission. Stefan, is that something the market should be pricing in, given all the green on the screen we've been seeing, or is this something you just kind of look, admire, then kind of brush off?
I certainly think it's something that the market is aware of. Obviously, when you look at the big tech players, last night, of course, we saw the FTC potentially looking to pursue a breakup of Amazon. Alphabet today, Sundar Pichai, the CEO, is in London here. We saw that last night they announced that their CFO is going to become President and Chief Investment Officer. And so the CFO, former CFO, is now going to be focused on talking to regulators and also managing that loss-making other bets business, which we think is another catalyst when Alphabet starts to crystallize value and lower losses there. So clearly the regulators are looking to slow down big tech. But as we saw with Microsoft and Activision, they're having trouble stopping them.
Yeah, I actually have that Politico story in front of me, just the first paragraph. The FTC is finalizing its long-awaited antitrust lawsuit against Amazon. People familiar told Politico, a move that could ultimately break up parts of the company. Do you think they'll be successful in that, breaking up parts of Amazon? That would be massive if that happens.
Yeah, I mean, I don't know if they'll be successful. Obviously, I do know it'll take a long time for that to play out. And so it is an overhang. We're seeing that overhang already reflected in Alphabet's valuation, where, again, there are some pursuits to break up that company. Microsoft now under a bit of pressure in Europe as well from the regulators for their bundling of teams within Microsoft Office. So all of these big tech players are under pressure from a few different sides. Of course, the flip side is it could unlock some value. So if you look at Amazon, if they do spin off AWS, then that could unlock value. But that's not what the regulators are looking at. I think they're looking more at the Prime business and some other businesses, which could actually maybe damage that flywheel effect that Amazon's so keen on.
Well, Stefan, what would hypothetically a breakup actually look like? You said it might unlock some value. What does that mean? Does this mean spinning off the cloud unit? Does it mean spinning off the logistics unit? What are the pieces that are breakable?
Well, I don't think Amazon wants to break up, and they've said it over and over again, especially Amazon Web Services. That's the obvious one that investors continue to ask about because the synergies with the rest of the business aren't as evident in terms of driving that flywheel effect for the consumer business. However, Amazon have said they're committed to kind of keeping that in-house. I think what regulators would be looking at would probably be more disruptive, which would be breaking out the Prime subscription business, for example, away from the core consumer business. And as we know, they're very closely tied.
And what does that then do to the pricing then, Stefan? We look at Amazon as kind of this proxy for the consumer, a lot of it which is traded on things like Prime Day, for example, even though a lot of their business is pivoting to things like the cloud. What does that then do for its pricing if you start to see not only a consumer slowdown, but a pricing deceleration as well?
Well, we'll see. I think Amazon Prime obviously has raised prices recently in both the U.S. and internationally. They probably do have scope to increase that more over time. So that could be something that they might look to do. But for now, I think Amazon continues to focus on trying to turn around overall profitability in the consumer business. It was break even in Q4, break even in Q1. The guidance for Q2 is for it to be break even at best. So they continue to have some profitability pressures there in that core consumer business. The other thing we're concerned about is in Amazon Web Services. You now have new competition from Oracle Cloud Infrastructure on the low end, and more competition as it comes to AI, of course, from Microsoft and Google Cloud on the high end. And so that's putting pressure potentially on margins for Amazon Web Services as well.
Stefan Slowinski of BNP Paribas Exane. Coming up, we thank you as always. Coming up, a strike avoided. UPS reaching a tentative labor deal with Teamsters Union. More on that and broader labor negotiations next. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
I'm working for the employees. I'm working to make their performance bonus bigger, and I'm working to make their plans their engineering divisions more competitive for the midterm and the long term. So I'm working for them. That's my answer. And as long as my salary is 90% based on results, which is 90% variable, that means that if my salary is okay, then the company is okay, and that's my mission. I just would like to challenge my UAW partners to be constructive, collaborative, and open-minded in the discussions we are going to have together, and I'm sure that we can find a win-win.
Stellantis CEO Carlos Tavares there speaking exclusively with Bloomberg TV earlier this hour. Joining us now to discuss more about those recent labor discussions. The UAW is just one part of it. Ian Colgren of Bloomberg Industry Group in Washington all over that story. Look, Ian, we're going to get to the UPS in a moment, but a core piece of the UAW story is this kind of multiple tier system when it comes to wages. Now, it looks like UPS has found some sort of solution to eliminate that. The UAW did that a couple years ago. What kind of precedent is that setting for negotiations across the country?
Well, it's certainly creating some momentum, Kriti. This is something that unions have been trying to address, trying to get rid of for a long time. It's not a new idea, but it got a lot more popular during the Great Recession, especially in autos when these companies weren't doing well, needed bailouts from the government. And now unions are trying to claw back, reverse a lot of those concessions they made, which isn't easy. Once you give something up at the bargaining table, it's not easy to get it back. And it is notable that the UAW was able to do this in the John Deere negotiations in 2021. And now the Teamsters, even more notably, have been able to do this in their negotiations with UPS.
To that point, O'Brien calling this scenario that UPS blinked. That's how he described it. Is that a fair description of how this agreement between the Teamsters, between UPS ultimately went down?
Well, certainly from what we know, UPS was the one that wanted to come back to the bargaining table. UPS has not been as open or vocal as the Teamsters have about how this whole deal went down. But when my colleague and I separately spoke to Teamsters President Sean O'Brien yesterday, he said he got a call from UPS a week ago today when he was in Los Angeles for a rally with union members, with UPS saying that they wanted to talk again. They wanted to sit down at the bargaining table. They traded proposals. O'Brien says the initial ones weren't close to what he wanted, but they were enough to get the Teamsters back at the bargaining table. And ultimately, the deal they got will get wages for full-time workers, full-time drivers, close to $50 an hour, and it will immediately get a raise for the part-time workers that the Teamsters had really been holding out to get a better deal for.
So what happens next here, Ian? I mean, we had the Teamsters president on Bloomberg Television earlier this month. It's worth repeating that we, of course, have invited UPS on our air as well to talk about this. But what happens next? This is just a tentative agreement. Walk us through the timeline here ahead of the Monday contract end.
Right. Well, as you mentioned, this certainly is not done. This is a tentative agreement, which means that Teamsters members have to vote to approve it. It is a proposal that is being brought to them by their leadership, and they have to say yes, which historically has been a pretty easy win for union leadership once we've gotten to this point, but it's certainly no guarantee. You remember the rail strike that we almost had last year came about largely because members voted to reject the initial agreement that the Biden administration had between the two parties. And a lot of those members actually were Teamsters.
Ian, we got to leave it there simply because of time, but it's a lot to digest to your point. Ian Colgren of Bloomberg Industry Group all over it. We're going to have the Teamsters president join surveillance in just a few moments. Stick around. This is Bloomberg.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Inflation remains well above our longer-run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
I would say we're close, but we still have a bit of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
it is decision time for the Federal Reserve and Chairman Powell, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and the wonderful Bramo back in the hot seat, and Jonathan Farrow. Your equity market on the S&P 500 slightly negative this morning. Earnings from Alphabet, the stock higher. Microsoft, the stock lower. Meta coming up a little bit later after the closing bow. TK, before we get there, 2 p.m. Eastern time, it's Chairman Powell and co.
It's Chairman Powell, and I'm going to go to earnings, John. I think you're dead on to talk about Google and Microsoft. And frankly, LVMH, the growthiness is out there. There's this worry, that's that worry, that the backdrop for the Federal Reserve System of the United States of America is a growthiness of America that's been the great missed call of 2023. And you can sum it up you want. Give me 8 worries about this stock, that stock, the other. The fact is the backdrop for this Fed is a vibrant America.
No projections, no forecast from the Federal Reserve today. You'll get a statement and a news conference. Bramo, welcome back. We'll get into the statement. To Tom's point, the growthiness, how they characterize that in the first paragraph of that statement, and what they say about inflation and the improvement we've seen in the last couple of months.
And whether there'll be a dssent from the one and only Raphael Bostic, among others, but how much you're going to get some sort of unanimity among participants that are looking at growthiness in certain aspects, perhaps in the consumer-facing, consumer spending industries, and less so on companies spending. You saw that with perhaps a little bit of a disappointment with some of the Microsoft earnings, as well as going forward what some of the consumer outlook is in specific sectors.
So back in the middle of June, there was a feeling there was more to come. 1 month, 2 months later, there's a feeling it's one and done. Which one is it, and does that change again in 1 month's time?
This is a great point, and something that I was reading in a lot of the notes, that there's a 44% chance priced into the market of a September rate hike following on to what we're expecting today. This could change in a heartbeat. We've been here before. We've had this this movie play out where people said no more, and then all of a sudden you see housing reaccelerate, you see other areas reaccelerate, and at what point does that lead the Fed to make a very different decision?
Alphabet this morning up by 6.7%. We mentioned the earnings as well. We'll keep an eye on that. Microsoft is down by 3.7% after the close a little bit later. You're going to hear from Meta. Then next week, tomorrow, Amazon, Apple on deck. Here's the state of things right now. Equity futures on the S&P 500, slightly negative on the S&P, just a bit softer to start the day. We're down by 0.1%. Tom, yields basically unchanged. Your 10-year 388 this morning.
I'm glad you mentioned yields, and that, that's, I guess, what you've got to watch here. The 10-year real yield, 1.50%. There's been a churning there as well. I really don't know what the Fed PhDs look at here. I'm going to look at what Drew Mattis said yesterday to us. Bramah was not here. And in Bramah, what Drew Mattis said is he models out more long-term a vibrant 3% real GDP. That is an outlier call. How does that change Fed policy out 2 years, out 5 years?
And we get GDP tomorrow, which might give some kind of read on this. Again, though, and this is something that we keep talking about, how do you dovetail the fact that you are seeing a reacceleration at a time, John, when otherwise we're looking at other areas that are falling off, like corporate spending?
Well, beyond corporate spending, think about the split right now, Bramah, between not just the United States, but Europe. Not just Europe, but China. TK and I had this conversation yesterday, and I know it's something you've been thinking about. Germany's in recession. China's throwing stimulus at the issue. And the United States has a very, very different problem in the eyes of the Federal Reserve right now.
And that's, I think, what people are looking at. We're looking at today is this idea of the Federal Reserve meeting, which is going to happen at 2 p.m. After that, we are going to, and before that, we're going to have our special at 1:30 p.m. Bill Dudley will be with us, former New York Fed President Bob Michael, as well as Diane Swonk to all weigh in before and after. Before that, 10 a.m., and this is what we were talking about, June new home sales. This is where we're expecting to see some sort of reacceleration, which we've seen even in pricing. How does the Fed deal with something like this, which this was supposed to be the most interest rate sensitive area of the whole market? And aftermarket, we were talking about this, Meta reporting earnings. Just to give you a sense of what we're looking at today. To date, we have seen 97 S&P companies, about 20% of market cap, report. Another huge chunk coming this week and then next week. But what I'm watching is this divergence between corporate spending and consumer spending. We have seen that consistently, where you see companies really pulling back even as the consumer, John, continues to step up their spending.
A look out for ad spend a little bit later on Meta. Joining us now, I'm pleased to say, Max Ken, the Chief Multi-Asset Strategist over at HSBC. Max is bullish through the rest of this summer, and it's the then what we're interested in. So, Max, let's talk about it. Why through the rest of the summer? What happens after that?
Yeah, look, good morning. I guess what we have right now is still a pretty supportive Q2 reporting season. You guys just mentioned it, right? When we look at, the latest tech earnings. But in total, I think I would say until then, we've had these pretty negative downward revisions in earnings expectations. So that means the bar to beat is pretty low. In fact, when we look at already sort of average earnings surprise factors or beat rates, they are a bit above historical averages for the US. So that's good. I guess there's a bit of perhaps even upside surprise potential on the manufacturing side in the US, right? When we look at things like CapEx intentions, regional Fed surveys, things like new orders over inventories, they've all been picking up in the US specifically. And all that would tell us perhaps that those two things over the next couple of weeks and months are pretty good. Thereafter, that's the question mark.
Describe the wall of money that's out there. One of the themes of late July is a belief that the money's there and on a first order condition, institutional money, whatever, is going to go into quality bonds and quality stocks. Has HSBC identified how much money is actually out there?
Yeah, look, indeed, when we actually look at real money investor positioning, right? So sort of how underinvested or indeed how exposed they are to several asset classes, what we can see is that since late last year, around October, they've been consistently underweight in things like equities and high yield credit, right? So they've consistently been parking cash on the sidelines or sort of hiding out in lower risk asset classes in anticipation of that US recession that so many were expecting, and that just isn't happening and is being sort of ticked down and down and down. So there is, I think, particularly among discretionary investors, particularly among real money investors, still an awful lot of money and an awful lot of underweight positions in those risk assets that really have to be corrected, I think, over the next couple of weeks and months. And that should keep the equity market in risk assets in general, really quite upbeat in the next couple of months.
Max, I've got to give you credit. You were bearish last year, then you went full bull this year, talking about how you are expecting us to get ahead of the recovery on the other side. You extended that bullish call, the risk on call, through the summer. At the end of the summer, things might change. What would that be?
So I think you guys actually been talking about it, right? What is this fine balance, this fine line between activity is better, but on the other hand, that actually might mean that inflation is going to pick up a bit more, right? So we've got to try to figure out the point where the market says, and where the market basically stops cheering the better activity data, the positive surprises on earnings and on top-down data, and when it starts to worry about inflation again. And to us, that really is sort of a worry perhaps towards Q4. Perhaps we're even too early for that, and we need to extend it towards year end and into the new year. But I think one of the concerns that we have is that US headline inflation on our measures is going to reaccelerate slightly into year end. And that might dent some of the hopes of sort of this continued immaculate disinflation. And then perhaps really investors are starting to worry a bit more, similar to what we had in February, a little bit more about, hey, you know what, better activity data actually means higher inflation, and that perhaps means a need to keep policy rates in restrictive territory for a bit longer.
A lot of notes that I've been reading and a lot of people I've been speaking to, Max, think that the Fed has taken a more dovish tone recently. You hear on the margins, the Raphael Bostics, but others as well come out and say, perhaps things are disinflating in a controlled way where we don't have to go too much further. Is that accurate? Do you think that that's going to have to change as we see signs of what you just predicted will happen down the line?
Yeah, look, I think that's exactly the danger, right? That we're all getting sort of lulled into, oh yeah, everything's fine. You know, we don't need a recession. We don't need any slowdown anymore. Everything's, you know, inflation is going to slow down by itself. We're all fine, Goldilocks, and you know, the S&P is going to go to 10,000. So that's a bit. I think the concern I have, that we're getting a bit too calm, right, in the second half, and we're all starting to agree a little bit too much with each other and saying, hey, you know, we've won this inflation battle, it's completely over, it's a disinflation for the next year and a half without any kind of concerns. So in fact, when we look at our economists' projections for the next, let's say, 18 months on Fed policy, we're much more hawkish compared to the market and compared to consensus. So that really is the key concern. For us, it's not the concern around recession. It's not the concern around an earnings recession or margins. It's really the concern that perhaps we're getting a little bit too comfortable around the inflation trajectory too soon.
You know, Max, I look at the call in the stock market, and I mean, I believe it's the fourth longest Dow Jones Industrial Average track. There's broadening out. You know all the themes. You're writing about them each and every day. What does all this good news mean for the stocks that have already advanced 30, 40, 50%? What do you do with the glory stocks of 6 months ago?
To be honest, you still buy them. So we're still overweight in US equities more broadly, right? So still quite like the whole tech story, the whole Goldilocks story, right? That whole disinflationary story is still intact, right? Don't get me wrong. This is a worry that comes perhaps down the line in 3 to 6 months. But until then, right, we can still play this disinflationary wave in the US in particular, and on top of that, the better activity data and the better earnings and the resilient margins. So that's still this sort of pretty nice Goldilocks picture where in total, what you want to do during those in this environment is you want to go broadly short dollar, long the growthy part of the equity market, and long carry assets like emerging market debt or high yield
That's
credit.
CFA talk.
Is that right?
Growthy part of the market.
What level's that, Tom?
Level 5.
Max
Max got there, I didn't.
Chief multi-asset strategist over at HSBC, constructive going through the rest of this summer. And as Lisa pointed out, last year, right to be bearish. This year, right to be bullish. It's been a pretty decent 18 months for Max Kentner and the team.
Yeah, to review, and you were way out front of this, John. Looking at luxury here. I think you were looking at it really hard 6 weeks ago or so. This is the conundrum right now that Max just addressed. There's a lot of Andrea Feldstedt writing for Bloomberg, OMG, Arnaud, they're going to do the Paris Olympics, but the bloom's off the rose, worry this, worry that. Dana Telsey overnight just slices through the analysis, raises her price target from 925 to 955, an 11% lift from where we are right now. And that's the conundrum you've got is growthiness. What do we do with Google? What'd you say? It's up
You just say
6%
AI.
pre-market?
Google is, yes, Tom. And if you look at some of the statements from the CEOs, both of these stocks, of course, Google and Microsoft, have been used as vehicles for your AI hopes and dreams. And it was interesting yesterday, just opening up the individual statements. First line of each quote from each CEO, Satya Nadella. Organizations are asking not only how, but how fast they can apply this next generation of AI. And then you heard this from the Alphabet CEO, our continued leadership in, guess what, Lisa, AI. Seems to be the buzzword of the moment, doesn't it?
And when you look at the earnings, where is the AI profitability? Where are those revenues? What it comes down to is ad spending, and what it comes down to is cloud spending, and what it comes down to is the nuts and bolts, and then you have the investment. What do you make of Ruth Porat changing her title to Chief Investment Officer?
What is that? Okay.
I have no idea.
Does anyone know?
I don't think so.
So
I was
you're
looking.
transitioning from CFO to president and CIO. What is that?
It's a newly created position, and I was looking up more details. There were none that I could find in terms of what's she going to be investing in, AI, or is this going to be something else?
Ruth came from New York and went out there. She served 5 years of pain as CFO, and what they want her to do is ride herd on the many dream investments and bolt-ons and this of the founders and of recent Google is, well, she's the one that's got to pick up the debris and figure out what to do with it.
Well, and please, you've got a better understanding
She's
of
like
this than I have.
Chief Executive Bolt-on Officer.
Oh, that clears it up.
Wall Street have been big fans of that individual for a long time.
Yes. Yeah.
Just curious to see that shift from CFO to some newly created role. Seema Shah in the next hour, Principal Asset Management on this equity market. Equity's a little softer. Meta after the close. Chairman Powell a little bit later from New York. Good morning.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
The ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
The ECB is still catching up. They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Most questions will persist up until Lagarde goes on that podium.
Coverage begins Thursday on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come? Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
Threat remains inflation. We've had some good news on output growth. We've revised upwards a little bit, and there was quite a bit of resilience in the global economy. but especially in the first quarter. But, you know, the momentum is slowing down, and this is why at the end of the day, the revision is not stronger than what it is, and why we're going into next year also with relatively modest growth.
The International Monetary Fund with a mild lift to their forecast for global growth, but ultimately, as the IMF chief economist pointed out, they're looking for modest growth into 2024. Live from New York City this morning, good morning to you all. Chairman Powell making his Federal Reserve decision a little bit later on this afternoon. Most people on Wall Street anticipating another hike from this Fed. It's about the what's next. And the what next, the clues for what's next, you'll get in the news conference shortly after the decision. Three-day winning streak on the S&P 500 going into potentially that Fed hike. Equity futures right now on the S&P negative by 0.1%. Microsoft a major weighting in some of these benchmarks, of course. Makes up about 10% of the NASDAQ 100, I think. And NASDAQ is getting hit just a little bit more because of this move in Microsoft, down about 3.5% this morning. The NASDAQ is down by 0.2%. Yields are going absolutely nowhere, 388.85. The euro's been going somewhere and all over the place, Tom, over the last couple of weeks. We've had 6 days of euro weakness replaced by a single session of euro strength. Euro dollar 110.75. Positive by 2
Since
tenths.
Lisa's been gone, we've had an adjustment in euro, but also I'd note strong yen today as well. It's some interesting dynamics in FX to the weekend. What I would note, John, into earnings season, well, I have yet to see a summary. You mentioned it earlier. 40%, 20%, 80% of earnings are all happening within 10 days. We're going to be a lot wiser about the growthiness and the valueness out there in 6-8 days. I mean, a lot wiser.
It's about 40% of the S&P 500 market cap this week. I had a question for you, actually, Tom. Entry price leather goods. What's the entry price for leather goods at LVMH? Do you know the answer to that? They said they're softer, they're weaker, apparently. What is an entry price leather good at LVMH?
Entry price is the partition here. For example, at Tiffany's, where they've just spent $1 gazillion, including having a beautiful display of Audrey Hepburn's dress from Breakfast at Tiffany's. I don't know if you know this, John, but there's a floor devoted to entry price. It's called silver. And, you know, they don't mention it, but you go up and it's gold this, gold that, gold that. And there's one floor for floor 12, floor 18, I can't remember where, which is all silver. And it's like entry price. And this is, you know, this is the huge deal. I would suggest, and I'm speaking completely uninformed as an amateur, we have to ask the question, were U.S. sales down because of a lack of Chinese tourists? I mean, I think that's
an interesting question,
a really
Tom.
interesting question.
But we've seen this at Richemont. We talked about it yesterday going into this print from LVMH, and you've seen it, Lisa, from LVMH. US seems to be a soft spot for some of these luxury players.
And China was a strong spot. This is the irony. We've been blaming China for the slowdown in potential, or the potential slowdown in luxury sales. It's not. It's in the U.S. By the way, I'm looking at Givenchy bags, purses. They go for, here's a cheap one for $1,650.
Is that cheap, is it?
I have no clue. This isn't really my purview. But
what entry level? Are we talking about wallets, purses? Belts?
I don't think that's
it
entry
depends.
level.
Belts.
I mean, a guy like, you know, come on.
Money clip.
You know, Terry Haynes knows they bulldozed this is west of Ford's Theater, where David Rubenstein and others put so much into part of our national character. And they basically bulldozed 6 blocks of Washington, D.C. And Terry Haynes knows you can make a circle there from Tiffany over to Gucci, go around to Bottega. I mean, that's the whole luxury branding.
That's your DC shopping lab.
Yeah, and we're going to do that right now. We're going to lighten the wallet with Terry Haynes here, founder of Pangea Policy as well. I look out the window of our office, Terry, at what they did to Washington. It's not the Washington I knew from my childhood as well. Terry, August beckons. John's brought this up a couple times. We're going to have a Republican debate. It is illogical that they can have a constructive debate without the former president of the United States. How are they going to do that?
Well, they might have a more constructive debate in some ways, Tom. It provides the challengers an opportunity to differentiate themselves, firstly. Secondly, if Trump isn't there, it gives them an opportunity to punch without being punched back. There's probably some value in that, too. So we'll see how that goes. But yeah, that's about a month away now. So it tells you a lot about how little will come out of Washington in the succeeding weeks that we're already talking about something that will happen probably 4 or 5 weeks from now.
In the air-conditioned August doldrums of Washington, what are you focused on this weekend? Most of us are unfocused. Help us get focused. What matters right now?
The phrase that is on the lips of everyone in Washington is 2 words: jet fumes. The deal will be to try to finish the week and get out as much as possible. Beyond that, what you've got a few different inquiries. So there'll be some heat on Homeland Security Secretary Mayorkas. There's the bubbled up talk about potential impeachment inquiries in the fall or in the winter, and finally, I know it won't be lost on you, Tom, that there's going to be a UFO hearing today in the House too. Cheap joke, but some people would go right at that number 1. So I'll leave it for number 3.
Really, people are going to go to the
This
UFO
is a big deal.
hearing.
Well,
I mean, what, the UFOs or the
I think
the balloon?
Scully will be there. She'll be in the back.
The frequency of the sightings
You're not even able to say
is much higher than people previously appreciated. And we're going to find out more detail about that today. Just how much the US government has been hiding from us, Bramo, about what is happening above this country in our airspace.
And there's going to be sort of like an off-key pitch behind us the whole time.
It's really important. Bet you're talking about it tomorrow. You'll see.
Okay, well, meanwhile, we are talking about the real world as well. And Terry, I would love to get your thoughts quickly on the meaning behind the UPS deal with the Teamsters, especially as we talk about inflation ahead of the Fed meeting and what this could mean in terms of wage inflation. We get ECA on Friday. How do you think that President Biden is going to weigh in on this at a time where inflation is a concern, but where he's considered the most pro-union president out there?
Well, it's interesting that, he's at the same time that he's the most pro-union president, the Teamsters essentially stiff-armed him and told him to stay away from it because they thought they had a better shot at a good deal. So that's happening. We'll still, we will still have some strike activity going on, and it'll be through the summer and the fall, and it'll still be beyond the White House's ability to try to successfully resolve any or all of those. So I think net, it's going to be a bit of a drag on the economy and kind of feed into inflation fears, which, is a data point that going forward, is likely to inform the Fed's future track as well.
Terry, everything the president says right now is under a microscope because of his age going into the campaign next year. There was a quote yesterday that a lot of people are mentioning in different ways and taking their angle on it, that they need to based on who their audience is. What did he say about ending cancer? Terry, what did the president say?
Fundamentally, this is a follow-on to the cancer moonshot that he's been touting and pushing ever since the days when he was vice president. That effort will continue. There will be some funding from the Congress that will continue on that. But beyond that, I don't think it was anything particularly meaningful.
Terry Haynes of Pangea Policy. Terry, thank you. Much confusion over that yesterday, Tom, as to whether the president said he had ended it or we can end it as we know it.
I'm glad you brought it up because to me the confusion is not a single item. It's happening every 4 days, every 8 days. Where are we in a year, frankly, with both of our aged candidates for president? I don't, Rishi Sunak, what's Rishi? He's like 38 years old.
38 years younger than him, maybe.
Sunak was playing for Portsmouth, 6 years ago?
Tom, it seems like an off-the-cuff, silly statement, but at the end of the day, I just think the way the media reacted to that in the last 24 hours, just an example of what this is going to be like for the next 12 months.
Exactly. For the next 12 months is the key phrase.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
You know that Tom said you'd been in Norway
Yes.
for the last week.
Yeah,
You're aware of that.
Wasn't
Can you
too
tell us-
far off.
Tell us all about the fjords.
I actually went to
A little
fjords.
bit
Did you see
later.
a polar bear?
But not the
Seriously?
Norwegian
But not
fjords.
Norwegian
Okay.
fjords.
You didn't see a
Right.
polar
We
bear.
did not see a polar bear, no.
No.
Damn. Get a refund.
Is that the review?
That's the review.
Okay, good.
I was in
Okay.
Alaska.
Well, here's the price action if you've tuned in for equities. Equity futures on the S&P negative by 0.2% on the S&P 500. On the Nasdaq 100 down about 1/3 of 1%. Microsoft making up about 10% of the weighting of the Nasdaq 100. So there's a reason why we're a little bit softer on the Nasdaq relative to the S&P this morning. I'll get to those earnings in just a moment. In the bond market, 2-year, 10-year, 30-year. Treasury shaping up as follows on a 2-year, 485.78. Yields a little bit lower on the session. Go back to the middle of June when the Fed last met. At the close, your 2-year, 469. So interesting that we've had this inflationary, disinflationary development between the last meeting and this one. The Fed backing away potentially from the idea that we get 2 hikes, maybe we only get a single one. And the 2-year in between the meetings, Lisa, higher, not lower from last time around.
And this, to me, is one of the distinctions that I expect to hear more and more about. How long can they hold rates at the highest levels, which is expected to go up since 2001? And how much is that going to become a focus? Because if they're not cutting rates, what does that do to the rest of the curve?
That's the bond market. Let's push it through foreign exchange. The euro, 6 consecutive days of euro weakness against the US dollar. Replace that with a touch of euro strength. 110.82, just short of 111 and positive 0.2%. But TK, you and I have been talking about it for the past week. The data out of Europe just not getting it done.
I'm
Not
gonna
good
put
going into the ECB.
Edge of idiosyncratic. I mean, I got a 27 on lira. I'm not there fixed, 26.95. That's idiosyncratic. I'm going to suggest this week euro is about European GDP weakness because DXY, the blended index, 54% euro. DXY really hasn't moved. This is a euro-specific story.
European
and
Central
Lagarde has
Bank
to face that.
decision coming on Thursday. BOJ coming on Friday. Before we get there, under surveillance this morning, investors expecting the Federal Reserve to raise interest rates by another 25 basis points. A hike today would put rates at their highest level in 22 years. Two-part story today, no projections, so you get the statement at 2 p.m. Eastern Time, then you get the news conference with Chairman Powell at 2:30. In that news conference, Lisa, I think you've touched on the most difficult part of today for Chairman Powell.